Welcome, everyone. So this is an overview of research that Bodo and I have done on insurance markets. We're going to break it up into like 4 parts. So Bodo and I are going to be alternating. So the first part is really giving you like a broad introduction of insurance markets, why we think there are sort of like important questions that can be answered by financial economists in terms of like what is the risk of the sector and how it changed over time. So to get started, like what are sort of the key like roles of insurance companies to get started, in the economy? So first of all, insurance companies play an important role to diversify like idiosyncratic risks. So for instance, life insurers, they sell annuities, which insure the risk that you live very long, life insurance, which insure the risk that you live shorter, and of course, accident and health insurance. Then you have property and casualty insurers, which insure like risks to your home, to your car, catastrophe insurance, and things like that. Okay, so that's like the first role that they serve. Second, and increasingly importantly, they have sort of like started to smooth risk across cohorts or across different groups of investors by sharing sort of like aggregate risk across different groups. And so this became particularly important, as we will see, with the decline of defined benefit pension plans and Social Security. And insurance companies have been introducing products that have replaced those older sort of like systems, but it changed sort of the role that they play in the economy. Thirdly, a lot of the insurance products, they come with like tax benefits to move money to like the next generation, for instance. And so for tax efficient investing, insurance companies also play an important role. And lastly, given the fact that once you buy an insurance policy, you pay the premiums upfront, insurance companies, they invest a huge amount of assets. And so they're very relevant for macro investing and hence for growth. And we will see later that insurance companies are actually the largest institutional investor in corporate bonds. And so understanding corporate bond markets really means understanding like the objective functions of insurance companies when they allocate this capital. So one thing that is important, though, to realize is that the insurance sector has sort of like changed a lot over time. And so the traditional risks that they insure is interest rate risk, in the sense that a lot of these contracts are very long dated. And so there's like a lot of duration on the liability side of the balance sheet. And they try to match that with the assets that they buy on the asset side. On top of that, there's some like aggregate longevity or mortality risk, just improvements in medical treatments and things like that. And then there's changes in policyholder behavior. For instance, when interest rates are like high or low, then you see like changes in lapsation behavior, meaning that when people like drop their policies and things like that. Now, insurance companies have a lot of like experience managing those risks, like a century worth of experience essentially. And so what they do is they, as I already mentioned, they match up duration on the asset and liability side. They sell both annuities and life insurance, which are the opposite side of the bet on improvements in mortality risk. And there's a whole fee structure in place to discourage that you quickly drop your policy after you bought it, which are costly sort of like to the insurance company. And so as a result, sort of like we felt that there was a pretty strong prior in the academic literature that insurance is sometimes viewed as a bit stable and a bit boring. And if there's any risk, then a lot of the work has focused on the asset side of the balance sheet, where the insurance companies take on some credit risk by investing in corporate bonds. And that's pretty much it. And so what we want to argue is that that's a very good description until the 90s. But then like the insurance sector really changed. And at this point, there's a lot more going on that and sort of like important questions that we can think about as financial economists. And the toolkit that we have available could be very, very useful in this sector. And so the kinds of risks that we want to talk about are the following. So first of all, they moved away from just like idiosyncratic risks to also aggregate risks. And the key product line to think about is variable annuities. And I'll talk a lot more about those later in Moto as well. But think of those as essentially like mutual funds with like minimum return guarantees that span over like very, very long periods of time. And so that creates sort of like aggregate risk on the balance sheet of insurance companies. Now, how do they manage this? In part, they use derivatives. So now we need to start thinking about how they, what kind of hedging strategies do they implement? Do derivatives like hedge or not? Also, these contracts, these variable annuities, they have like embedded guarantees, and that sort of generates a kind of interest rate mismatch that is much more complicated to manage than the traditional sort of like insurance products. in particular in a low rate environment where like issues related to convexity become more important. Another feature that started around the turn of the millennium is that insurance companies started to use something called shadow insurance, which is off-balance reinsurance, something that we know from banking, but it's also became very prominent in insurance markets. And then lastly, insurance companies became much more active in securities lending. And that also turns out to be a pretty risky activity, at least the way it was done until the financial crisis. And so sort of taken together, like the way to think about this is that the balance sheet of insurance companies is a lot more mismatched in terms of like aggregate risks. And insurance companies now increasingly use like advanced tools to manage those risks through derivatives, through like shadow insurance or off-balance reinsurance, and through securities lending. And so we want to understand sort of like what the impact is on the insurance sector. Now, one feature that we're going to highlight is that a lot of these risks are actually pretty concentrated in the largest insurance companies. And so the traditional view is that larger insurance companies are actually safer. Okay, there's more like there's a larger balance sheet, more of the idiosyncratic risk gets diversified, and hence sort of like both in the way the regulation is like set up and the way sort of like rating agencies view insurance companies, larger companies are typically viewed as being safer. Well, that view may no longer be true if these activities are more concentrated in the largest companies, and now it becomes a more relevant question if you start thinking about aggregate risk exposure and systemic risk. Okay, and so the other sort of like point we're going to emphasize like throughout these this presentation is that all these activities like derivatives, like shadow insurance and securities lending, there's going to be a trade-off. There's always going to be sort of two sides to these activities. Is that on the one hand, it could be the case that like regulation is simply like inefficient. And these kinds of tools allow insurance companies to work around these inefficiencies and run their companies more efficiently. But at the same time, they could also be used to sort of like increase leverage and risk exposure and hence make the sector as a whole more unstable. Okay. So just to give you a sense of like the importance or the stress that the sector like went through during the global financial crisis, we of course all heard about AIG. During that period, they lost like a huge amount from like CDS, which got a lot of attention, like which was 34 billion. But they actually lost another 21 billion, which would have been enough to get them into trouble from securities lending activities. Another company, Hartford, they were bailed out because of their variable annuity losses. And then there were a whole series of other companies involved in variable annuities or security lending that did apply for TARP as well, like Allstate, Genworth, and Prudential. And kind of globally, if you look to other countries, lots of other insurance companies got into trouble during this period. And we're going to show you that sort of like that fragility that was first like on display in 2008 has persisted over time in a large part because of the low rate environment.
Ralph, can I just ask real quick? I typically think of securities lending as highly collateralized. So how did they lose so much? Was there not enough haircut? What kind of securities? Do you have any detail on that?
Yes, I'll get to that later. So it's a great question. In fact, it was the short answer is that even though there's very tight regulation on how they invest their assets, once they receive the collateral back, they actually like reinvested that collateral in riskier securities. And there was very little like regulation, if any, or like very loosely defined regulation on how you reinvest that collateral. And so when the securities lenders called their collateral back, they had to sell sort of like their reinvested collateral in like mortgage-backed securities in the fall of 2008, and that's why they experienced the losses. So it was really on the reinvestment of the collateral. So you're exactly right that it wasn't the risk on the hedge funds, let's say. The risk was really how they sort of chose to reinvest the collateral. Okay, so let me start with like variable annuities, which is sort of like really like key to start to understand like where the aggregate risk is coming from. So as I mentioned before, the way to think about a variable annuity is that you buy a mutual fund. So let's say 60% equities, like 40% bonds. And then it comes with like a long dated put option. So every year, think of it as like you're going to get the maximum return on that mutual fund, and let's say 5%. And so that's a very challenging sort of like product to sort of like price and to hedge. Because this guarantee is going to span over like very long periods of time. Now, the growth in this market is really prompted by the secular decline of defined benefit pension plans and Social Security. So there's very strong demand from households for these kinds of products. But now, like if an insurance company sells those products, if it has to start like hedging these long dated guarantees, it has really like two options. One is that it can use options themselves, but the options that are traded on public markets or even over the counter, they have relatively short maturities. Like the options may go up to 5 years in extreme cases. And these guarantees really, they span like decades. Now, then you can sort of say like, well, we can use dynamic hedging solutions. But then, of course, like depending on the model that you're going to write down, you're going to get very different hedging strategies. And so now the insurance company is going to be exposed to basis risk. Okay. And so essentially the insurance companies have completed the market from the perspective of households, but now they are sort of like stuck with that risk on their balance sheets, and that could cause trouble. So just to give you a sense of the development of this market, here you see in the first column the variable annuity liabilities. So this is the sum of the mutual funds plus like the minimum return guarantees. You see that this increased like up to the financial crisis. Then it took a hit because of like, of course, a decline in financial markets, and then it gradually recovered. Now, the number of, as a fraction of sort of total liabilities, you see that this is now actually the largest liability of life insurance companies. And so it's really that sort of life insurance companies, like their main activity are these like variable annuities, and hence they're loading up on this aggregate risk. And that's a key thing to understand. The number of insurance companies active in this market like increased rapidly until the financial crisis, and then you see that like they gradually start to drop out. And later on, Moto will speak to that. Now, if you look at the fraction of the value of the liabilities that is represented by the guarantees, then you see that this was roughly around 1% of the value of the mutual funds, but then it jumped up to 4%, and it stayed sort of like volatile since the financial crisis. Okay, now these numbers may seem small, but it's important to keep in mind that insurance companies have extremely high leverage ratios. So the leverage ratio is order of magnitude liabilities to assets, like 90 to 95%. Okay, and so fairly small shocks to the liabilities have a large impact on their equity. And to see that, what we plot over here or what we show over here, is the variable annuity liabilities of the largest players in this market. Okay, so that's like what you see in the names in the first column, the variable annuity liabilities in the second column. And then you see the change in that reserve valuation, the value of these options relative to the mutual funds from 2007 to 2008. And then what you see in the final column is the impact on the insurance company's equity. And so you see that for some companies like AXA and Voya and over here, John Hancock, you see that those were like very large shocks coming from the variable annuity liabilities. Okay, and so there's sort of like two takeaways here. The first one is that if you look at this column over here, the liabilities underwritten by different companies, is that this sector is like very concentrated. And it's really the large companies like the AXAs, MedLife, Prudential, Voya, Hartford, AIG. Those are really like the largest companies. Those are the main players in this market. Second is that this is a very risky business, and it really can cause like large shocks to the equity position of these companies. Okay, so that raises the question, well, why don't they hedge this volatility, for instance, using derivatives? And the short answer is they do have like a significant derivatives portfolio, but there's a growing sort of like series of papers that shows that they don't fully hedge their variable annuity risk. And so sort of as a starting point, we're asking the question, well, in general, do derivatives like hedge or amplify volatility? That is, do they use like derivatives for like speculation, as some have argued in the banking industry? Or do they use derivatives at a high level to sort of like dampen the volatility of their equity? So there we get a pretty clear answer. If we look at the impact on insurance companies' equity with and without derivatives, then in this graph, what you see is that the dashed line is a growth rate of equity without derivatives. The solid line is when we add back the gains and losses from derivatives. And what you see pretty clearly is that sort of in 2008, they were helped quite a bit by their derivatives portfolio. In the subsequent years, you see that sort of the derivatives portfolio kind of did what it's supposed to do, and it sort of stabilized the equity position. Okay, so at a high level, derivatives help insurance companies to stabilize their equity position, but they don't perfectly hedge. Okay, and so that raises like a series of questions in terms of like, well, why do insurance companies not want to hedge their annuity risk fully? And there's a couple of answers there. And this also gets us into like understanding a little bit better about the institutional structure of this industry. First of all, you may have like standard risk shifting incentives under limited liability. And on top of that, there's also guarantee funds. So the way insurance companies are regulated is that they're regulated at the state level. And each state has their own guarantee fund. And if the insurance company goes under, then the guarantee fund steps in. And so that again sort of may give sort of like risk shifting incentives to insurance companies. And there's an older literature exploring that in some detail. Second, there's like different like numbers that insurance companies can look at, and that's a bit sort of like non-standard perhaps, in that there's a GAAP capital sort of like ratio that insurance companies have to report in their annual report. Then there's statutory accounting, which is like what the state regulators are using. That's being developed by actuaries. And then there's sort of like the economic sort of like targets that we would think about as financial economists. And there's a large literature that shows that these numbers are sort of inconsistent with each other. And so if you ask the question, like, is the insurance company perfectly hedged from an economic perspective? Almost by design, it would not be perfectly hedged on the statutory accounting, or it would not be perfectly hedged on the GAAP accounting measures. And so that means that it really depends on like what numbers you're using or what numbers the insurance company is targeting. And so one very relevant paper in this context is Ishita's Sense job market paper that was published in RFS. And what she shows is that insurance companies seem to be very sensitive to how the statutory accounting standards work. So that is how state regulators sort of like view the insurance companies. Because what she shows essentially is that she looks at two products that have exactly the same economic like risk exposure. But then the statutory like regulation is different, and what she finds is that one sort of product is hedged and the other one is not. Okay, and so that suggests that like the statutory accounting standards are very relevant. Now, at a high level, you may think that, well, if an insurance company is sufficiently well capitalized, then none of the statutory stuff, if you think it's sort of like inefficient, shouldn't matter very much. They just have a lower level of leverage. They implement their optimal hedging strategy, and that's about it. But that doesn't seem to be the case. So it seems that they're like really optimizing pretty close to what is optimal, or what is the minimum required from a statutory capital perspective. And that's why these kinds of rules become important. Now, the second reason why they don't fully hedge is because of this issue of model uncertainty that I mentioned before. Again, so these are very long-dated contracts. Knowing exactly what hedge ratios you need to implement is quite challenging. And that may be one reason why you don't want to go sort of 100% depending on the model you're using. And lastly, sort of like the perfect hedging instruments may not be available, so you're always facing some basis risk. And so that's sort of like a third reason as to why they may not fully hedge these risks. Okay, so then that leaves them sort of like with like some aggregate risk mismatch. So let me stop here and see whether there's questions.
Are there any questions? If not, Ralph, on the very last point that you made there, what would be the comparative advantage? I ask because in the context of banking, we have this behavior of deposit rates that's very unusual and affects banks' choice of duration. I'm just wondering if there's something like this going on here where maybe the policyholders are essentially willing to overpay for these puts, which somehow helps the life insurers, their franchise value somehow helps them to be natural providers of this. I'm just wondering what that could be, the comparative advantage.
Yeah, no, so I think that's a great question. So in terms of like one advantage that they have is that these are like very like long dated contracts, and so they can hold, they have a very stable funding structure in that sense. And so someone at the end of the day, if this is the demand from households that they want to have sort of this downside risk protection, then someone has to provide it essentially. Someone has to take the other side, and that can be sort of intermediated through insurance companies. And so that may be sort of like the right set of institutions to do that. The question that comes with that though is like what the right sort of like regulatory framework is to organize that. So what is the right sort of like level of leverage? What is the right set of like capital requirements? And how do we even think about sort of like stress testing those kinds of institutions? Okay, because you may have sort of a situation where risks are building up for like a long period of time. And given that these are very long dated contracts, think about defined benefit pension plans. They can sort of like be underfunded for a long period of time. You may argue one model versus the other that they're actually still funded. And that may become very, very challenging. And so the question is like, what is kind of like a robust sort of like regulatory framework, I think, if you want to argue that insurance companies are well positioned to sort of do this. But I think at a high level, sort of like given the strong growth in this market, what you learn from that is that there is a strong demand for downside risk protection over long horizons for people saving for retirement, and someone has to provide sort of that risk. Now, how much sort of like leverage that goes with that, if you want to offer those products, I think that's sort of the main question. Okay, so one thing that is suggested by this analysis is that that there is mismatch risk on the balance sheet of insurance companies, and so the question is sort of, can we see direct signs of that sort of mismatch risk? And so it seems natural to start thinking about what happened during the low rate environment, because one of the things that happens with these like variable annuity contracts is that insurance companies, they don't fully hedge their duration risk. We'll talk later on why that may be the case. And there's also like a mismatch in terms of convexity. And so when interest rates became unexpectedly low following the financial crisis, insurance companies' balance sheets got very stressed. And so we can see this directly in the equity prices of insurance companies. So what you see over here is a regression of the returns on the equity prices of variable annuity insurers. Okay, so we take a subset of the variable annuity insurers, like the large players in this market, and we sort of like look at their stock returns, and we're going to regress it on the aggregate market, like you would do with the CAPM. And then we're going to add the return on a 10-year bond. And so if you do this for the period from 1999 until 2007, then what you find is that the beta on the market is around 0.6, kind of similar, I know what you would expect from like an insurance company. It's kind of a boring, stable institution. It's kind of like not a whole lot of risk there. And the exposure to the 10-year bond is minus 0.4. It's insignificant. And so there doesn't seem to be at least sort of like a huge amount of duration mismatch during that period. Now, if you then look at the period like since the financial crisis from 2010 to 2017, and this is true if you update this sample as well, what you see, first of all, is that the market beta like almost doubles. So suddenly they become much more sensitive to movements in the aggregate stock market. And the second thing that you note is that there is this like very like sharp decline in this coefficient on the 10-year bond return. And so if you think about sort of like what happens now is that a 1% sort of decline in the 10-year yield, okay, leads to a 10-year positive like bond return, give or take. And that sort of like leads like the prices of these variable annuity insurers to drop by like 13%. And so insurance companies suddenly became very sort of like sensitive to movements in interest rates, and also much more sensitive to movements in the aggregate stock market. Now, if you sort of like look at other measures of risk, so for instance, like the S risk measure of NYU's like VLAB, also there what you see is that some of these large insurance companies show up. So this is a measurement taken in January 2020, so it's right before COVID started. What you see is that sort of like you see Prudential, like MetLife, Lincoln, Bright House, which is a spin-off of MetLife, and AIG. All of those sort of like show up as having a pretty high level of systemic risk, at least by this particular measure. Now, the other thing that I mentioned before is that these are like very long dated contracts, and that has an important implication. Like if you underwrite a lot of like generous sort of like variable annuity contracts before the financial crisis, then these contracts are going to run for decades. And so that means that if you have these contracts on your balance sheet, and then you sort of like go into this low rate environment, which stresses the balance sheets of insurance companies even more, then like all the future sort of like crises or recessions you're going to experience are going to be challenging for the same set of insurance companies as well. And so we can test this directly in the data. So what we saw during the COVID-19 crisis is we measured the drawdowns of different industries. So first, we look at the broad S&P 500. So that one fell by an already a remarkable amount, like close to 35%. Then the financial sector as a whole fell a little over 40%, But then these variable annuity insurers fell more than 50% during that episode. And again, sort of you see this fragility like on display. And in fact, they're actually closer to airlines during this period than they were to the S&P 500. Now, if you break it down at the level of the insurance companies, then you see that companies like Lincoln, Bright House, AIG, like the companies that really got into trouble in 2008, again, they experienced the largest drawdown during this more recent sort of period of market stress. If we connect them more directly, then here's what you get. The horizontal axis here shows you the drawdown during the global financial crisis of the different companies. And the vertical axis is a drawdown during the COVID-19 crisis. And so the main takeaway here is that the same companies that got stressed during the financial crisis got in trouble again almost more than a decade later during the COVID-19 crisis. And so the thing you want to sort of like take away from this is that insurance companies that underwrite these like very long dated contracts, the subsequent low rate environment like really sort of like display like showed their risk mismatch on their balance sheets, got them sort of like more exposed, more fragile. And then the next crisis that happened, again, these companies got shocked. We repeated this exercise during the banking crisis that happened recently, and you see exactly the same pattern. Okay, and so there's clearly sort of like some risks on the balance sheets of those insurance companies that we would like to understand.
Ralph, one more question.
Of course.
Much is super interesting, but one thing that came to mind on the betas that you showed in the 2010s that I was thinking is this is a time when the stock bond correlation was super negative. Mm-hmm. So can you imagine that maybe these two betas kind of offset in a sense, so that when stocks do badly, bonds do well. So all this duration, kind of provided a hedge somehow. Versus in the 90s when that wasn't the case. I'm just wondering, I don't think it would explain your scatter plot that you just showed, where it's like it's always the same guys that seem to do badly.
Right.
But it's just something that occurred to me. And in COVID, actually that correlation kind of got messed up. So maybe explains a little bit why it didn't work then.
What didn't work during COVID?
Well, in COVID, like treasuries didn't like rise quite that much. So maybe
Yeah, so on the first point, so here's one thing it's an interesting point. So one thing that we've done that sort of makes a more direct connection to the level of interest rates is that we repeated this exercise in Europe. And so there you actually see that the interest rate sort of declines like later. And so there you see that sort of like this sort of like increase in the exposure to the bond market happens sort of like follows very closely to when the long-term interest rate like falls. And so one could do a more direct calculation, which we've done in Europe, but we haven't done in the US, is to sort of like make a beta function of the level of interest rates and potentially also the stock bond correlation to try to tease those apart. Now, of course, stock bond correlation is hard to measure too precisely, but there at least sort of you see a pretty sort of like you see a different movement. It happens a bit later, and it follows very closely when the long-term interest rate declines.
Okay, so you're saying that looks more like a reach for yield type of behavior, if that's what's driving it.
Or the negative convexity, that if you have these long-dated return guarantees, then it sort of like stresses these balance sheets, and they become very sensitive to small declines in interest rates.
And one last question. Did you try like regressing on VIX or something like that? I know it's not as long-term as you'd ideally want, but if they're short a bunch of puts, you would expect a volatility beta of some kind.
So we haven't tried it. It's a good idea. Like in particular, given the fact, like you're absolutely right, that sort of like what are the risks that variable annuities is exposed to? It's interest rate risk, it's equity risk, and it's volatility risk. And in fact, it's like very long run volatility risk. So if you think about sort of like testing models of like long run risk and so on, variable annuities, at least there's like one set of like contracts out there that are being sold that sort of have an estimate of long run risk. And so you're right that we could sort of connect it to like VIX, or ideally a longer measure, like a measure of long run variance. Let me say one more thing on the duration mismatch. In Europe, so we don't have this data in the US, but in Europe, under Solvency II, there's much better data on duration mismatch. And there you see that indeed there is like a very large sort of like negative duration gap for insurance companies, which would be consistent with like this sort of very negative coefficient over here. So it's not to rule out that these other things sort of like affect these estimates, but there is some more direct evidence in Europe. Okay, so the next thing I want to talk about is the role of reinsurance. And so traditionally, when you think about reinsurance, then this is really about sort of like third-party reinsurance companies, and really for property and casualty. So what we have in mind there is that there's a company in, let's say, Florida. They insure against hurricanes. That's like huge shock to their balance sheet. So they share some of that risk to an insurance company in Illinois that is not exposed to those hurricanes. Now, that view of sort of like reinsurance is kind of like outdated, and a lot of the reinsurance now happens actually within the same company, and that's what we're going to refer to as captive reinsurance or shadow insurance. And really, what prompted this was a change in the regulation. So, starting in 2000 and 2003, there was a change in the regulation for life insurance contracts that made it sort of more capital intensive to hold those on the balance sheet of companies that sell it directly to consumers. Okay, and so that means that for the exact same contract, you have to record more liabilities. So it eats into your equity more. Now, what's important is that this only applies to operating companies. Those are the companies that directly sell to consumers, but it did not apply to reinsurance companies that are operating under GAAP. Okay. And so then some states were kind of like very creative, and they said like, well, you can set up this like special purpose vehicle, SPI, special purpose insurance vehicle, or a captive. And it started with South Carolina and Vermont, and says like, you can start your own sort of like reinsurance company. Now, the history behind those, which is kind of interesting, is that they were really designed for large companies. So imagine like Apple has like lots of employees. So they can start their own reinsurance company to run their own like health insurance like division without having to sort of outsource that to like an other insurance company and having to pay markups and things like that. And so now this was kind of like used by South Carolina and Vermont to start sort of like your own sort of like reinsurance company as being an insurance company. Now, this came with like some like big advantages, because under the GAAP accounting, you have to hold less capital. And there's also no risk-based capital regulation. So you're much more flexible on the asset side as well. Second advantage is that you get confidentiality of financial statements. One of the things that you have to notice sort of in this literature is that for insurance companies, we pretty much, know everything on the asset side. So if you're interested in their bond holdings, their private equity portfolio, their derivative holdings, we know everything. However, for these captive reinsurance companies, or that's why we call them shadow insurance companies, we don't have that information. So there's no confidentiality whatsoever. And on top of that, there's more flexible financial structure. So they can sort of get like funding through letters of credit. And in some cases, these letters of credit that are provided by banks are actually secured once again by the holding company. So it would be like sort of like MetLife, like reinsuring to MetLife, where the funding is guaranteed by MetLife. Okay, and so that's sort of like the kind of like the structure that we're exploring here. Now, how does it tie into the risk mismatch story and the fragility that I talked about before? Think of variable annuities as creating sort of like the risk mismatch on the balance sheet, and shadow insurance providing you a way to sort of like increase your leverage and potentially sort of like also increase the risk mismatch through these channels over here. Okay, so how does this work? So suppose you sell an insurance policy where the premium is $100, and suppose that the actuarial value is like $90. So there's a $10 markup. Now, if you keep this in your company in New York, then you record a premium income of $100 on the asset side, but the regulation is like very like conservative, and you have to put aside $110 to make sure that you can always sort of like cover the losses of that insurance policy. Now, what you can do is you can move it from the operating company in New York to your captive in South Carolina. The $100 leave, as do the $110 liabilities. And what you have to record in South Carolina is only the $90 reserve, which is this actuarial value, and the $90 in premiums. And so you free up this $10, and those $10 you can move back up to your holding company, and it can be used to sort of underwrite like additional insurance policies. It can be used to pay out as a dividend to your shareholders. And so you can sort of see that through this like scheme, you sort of like get around this like regulation over here, and you free up the capital. And so on the one hand, it could be efficient because insurance companies argued that this regulation was way too restrictive. But of course, on the flip side, it may make the sector much more fragile. And so we're going to define shadow insurance in a pretty narrow way to be sort of like clear that this is like a risk. So it's affiliated reinsurance. So it's within the group. It is with an unauthorized insurance company, meaning that the company in South Carolina is not licensed to directly sell policies to that like policyholder in New York. So that's what it means to be unauthorized. And it's also not rated. So that means that either the insurance company didn't seek a rating or the rating agency does not have enough information to provide a rating to that captive. Now, what is the risk associated with this? On the one hand, as I mentioned before, the funding is coming through these letters of credit. They have like shorter liabilities, a shorter duration than the insurance contracts. So when you talk to banks, then they will tell you that, well, if there's like concerns about the stability of the insurance company, they may simply not renew the letter of credit. And at that point, the funding falls through, and then the liabilities move back to the original insurance company. There may be more investment risk. That is something we can't check because there's no transparency, and there could be higher leverage. And so I already mentioned these sort of like parental guarantees coming from the holding company with the letters of credit. And there's one direct piece of evidence that we have that that this higher leverage may be like a real thing. So Iowa, for unknown reasons, decided in 2014 to release the financial statements of eight of their captives. If you look at their sort of like statutory accounting statements, which are the ones that take advantage of like shadow insurance, they have a positive number of like 1.5 billion. But then sort of they have a nice table which also says like, okay, if we were to apply the sort of like original sort of like regulation that applies in Iowa, and we wouldn't sort of like we wouldn't be able to take advantage of this like captive reinsurance trick, then actually the equity position would be a negative 2.7 billion. Okay, and so what that suggests is that there could be quite a bit of leverage sort of building up through captive reinsurance. And even to this date, if you pick up sort of like MetLife's annual report, it will say, it has a line in there that says like, if these practices would not be allowed, it would prompt regulatory intervention right away. And so this is really something that has been of value to insurance companies, and it still is. Now, to give you a bit of like a sense of the structure of how this works, here we sort of like open up MetLife's balance sheet. Okay, and so here you see like all the subsidiaries of MetLife. Now, what you see in the final column to start there is the total amount of reinsurance ceded. So when this number is positive, you move money off your balance sheet. If this number is negative, you take money like on your balance sheet. Okay, and so what you see over here is that all the companies that have a positive number, they have like an A+ rating, which is the highest rating. Okay, so those are the ones that are facing consumers. They see the A+ rating. And then all the companies that take sort of like all the insurance, the reinsurance companies that take money like under or policies on their balance sheet, they are unrated. Okay, and they're in locations like Delaware, South Carolina, Bermuda, Vermont, and so on. So it's very concentrated. And so there's a large sort of like amount of money sort of like flowing within MetLife. And there's a small sort of net number of like 5.7 billion that is then moved to like a third-party reinsurance company. Okay, now going with the main theme that I showed you before is that this activity is very concentrated. So these are the largest insurance companies by shadow insurance. And again, you see there's a couple of large players, which are the largest insurance companies. And again, it sort of like should challenge this notion that large insurance companies are by definition safer. Now, to see the trends over time, the following graph is very informative. So remember that the regulation changed in 2000 and 2003. What you see is that the total amount of unaffiliated reinsurance was fairly small in 2002, started to grow, and then you see that it flattens out. And then during that period, you see that the affiliated like reinsurance over here starts to pick up, which is driven by this like shadow insurance trend over here. Okay, and so the moment that like South Carolina and Vermont sort of like introduce this trick that you can have your own sort of like captive reinsurance company, the unaffiliated reinsurance company, let's say Swiss Re, is not that attractive anymore because you're sharing the profits with them, and it's optimal for you to go with your own reinsurance company. Now, the other sort of important thing, and this is going to be very relevant for what Moto is going to speak about. If you look at the life versus annuity, then you see that for life, you see the sort of immediate trend, and it's much steeper than for annuities. In fact, for annuities, it was pretty small until the financial crisis. And then you see this big jump over here. Now, the change in the regulation was really only for life insurance contracts, and so that part makes sense. Why they start using sort of annuity contracts is sort of a new puzzle that we need to think about. Okay, so the main takeaway is that like shadow insurance essentially sort of like increases the leverage of insurance companies and potentially sort of like amplifies the risk mismatch. Okay, so then the last aspect that I want to talk about is securities lending. And we already briefly talked about this in response to Alexi's question. So the risk here is kind of an unusual one because, as Alexi pointed out, normally when you engage in securities lending, like insurance companies have like lots of bonds, and so if you want to short that bond, you're a hedge fund. You get that bond, and in return you're going to give like cash as collateral. And then the hedge fund sells the bond, hopes that it goes down in value, buys it back cheaper, and returns it to the insurance company. Now, the gap in the regulation was that insurance companies couldn't reinvest the collateral into riskier securities. And that gap has since been closed. So this is no longer possible, but it did a lot of damage in the financial crisis. Because essentially what happened is that they started to invest it in this collateral in mortgage-backed securities and asset-backed securities. Then the short sellers came back in the fall of 2008, having bought back these bonds at much lower prices and happy to give them back to the insurance company. But now AIG and others had to buy back those MBS, or have to sell the MBS and ABS in the fall of 2008 to be able to return that collateral to these short sellers. And that was, of course, a terrible period to do that. And they experienced very large losses from just that activity. So just to give you a sense, this is the total amount of assets that was involved in these contracts. This is the total capital gain of total investments as a fraction of equity. And so you see for AIG, just this activity in and of itself would have been enough to bankrupt them. Okay, so it wasn't just sort of like the CDS contracts that we heard so much about. This activity was really very pronounced, but they were really not the only ones. You see some of the other companies here experiencing much larger losses than you would expect. To make that more precise, this is the investment return that the companies had without securities lending. This is the return that the insurance companies had that did engage in securities lending. And so they experienced much larger losses because they had to liquidate that collateral during that period. Okay, and so what you see over here is that during normal times, the activity is quite profitable, but it has exposed them to this massive drawdown during the financial crisis. Okay, but importantly, this gap has been closed in large part because of what happened to AIG. Okay, but there's some broader takeaways. So first of all, hopefully I've been able to convince you of the fact that insurance companies don't just do idiosyncratic risk. They're major players in financial markets, and there's a lot of areas of risk mismatch that we need to understand. And in particular, what we learn is that when there's these gaps in regulation, then that leads to risk taking. So we've seen that from shadow insurance, we've seen that from securities lending. The second takeaway is that there's a lot of risk concentration. So it's oftentimes setting up these activities like securities lending, like setting up your captive reinsurance companies, they require scale. And so larger companies are able to do that. And so the risk is concentrated in the top companies. The third takeaway is that underwriting certain contracts like variable annuities, that goes together with capital management. So you sell this variable annuity contract. Now you have this risk mismatch on your balance sheet, and it sets up this whole sequence of activities like derivatives, like potentially shadow insurance and things like that. And also, what we want to emphasize is there's always this trade-off between efficiency and risk. So sometimes the regulation is just suboptimal, and it's optimal to do things like shadow insurance to get around that. But it could also be the case that it increases leverage and risk. Now, to conclude, let me mention a couple of transmission risks in terms of what would potentially happen if a whole bunch of insurance companies would get into trouble. Perhaps the most obvious one is that, and we'll talk about this later as well, is that insurance companies are the largest investor in corporate bonds, and we already have a growing literature that shows that if insurance companies are constrained, they tend to sell certain bonds, and that has an impact on prices. If this like happens for like a long period of time, then that could increase the borrowing costs for firms. And we've seen during COVID that there was enough sort of like reason for the Fed to step in and stabilize corporate bond markets. The second one, which we think is just as important, is that if there's a large like failure of insurance companies, then you could sort of like households could get concerned that their insurance company is not going to be around when they need them. And for that reason, don't buy insurance. And that sort of leaves them exposed to sort of lots of like idiosyncratic risks, where insurance companies were just like incredibly valuable. Like the thing to realize that insurance companies are truly insuring tail risks. And so these are like really valuable products for households. And so any concern about their stability is like really a really big concern. And the trust that we've built up is really something to protect, we think. Lastly, there could be a spillover to banks. Obviously, they're like counterparties to like securities, lendings, and derivatives. They're holding the corporate bonds, of course, of banks, and they're also active in these letters of credits. And so there could be some connections to banks, but sort of in the big scheme of things, the first two are probably the most important ones to think about. So let me stop here and see if there's any questions before turning it over to Moto.
We did have a question in the chat before. Moto answered it. I don't know if you want to have a follow-up, Matt Nichols.
I was listening to your, I appreciate that, Alexi, thanks. I was listening to your presentation, Ralph, and my question was, if you were to read through the financial disclosures of these insurance companies before the events, would you have looked and said, well, here are the things that I see them doing to concentrate risks? It's easy in hindsight to find out who got cratered in a crisis, but if you were an analyst and you were reading through the notes, would you have come across these AIG as an example that got hurt during both crises? Would you have said, these guys just are, habitual offenders. They can't seem to figure it out.
Okay, so in addition to what Moto mentioned, is that there is like a lot of discussion in the industry beforehand that there was like, they refer to it as like the war on guarantees. So it was like very intense competition on guarantees leading up to the financial crisis. So that part is true, and there was a concern that the guarantees were like underpriced. In terms of like risk mismatch, I think it was much harder to spot before the financial crisis. For instance, one of the things we know is that the securities lending activity of like AIG picked up like very rapidly, and so that would have been very hard to catch, I think. Now the subsequent sort of like risks in terms of like what is the risk in like captives, what is the risk in with the low rate environment. I think there we have a lot better, now we have a much better understanding that those risks are still there. And so I think we have a better sense, and there is sort of like a broader concern that there is some instability potentially there that we need to understand better. So I think sort of like I think there's more of a realization that there is sort of like risk mismatch. In terms of like financial statements, as I mentioned, so even like a company like MetLife says that like if captive insurance reinsurance would not be allowed, which means that sort of they would merge their balance sheets with the captive and the operating company, then that would trigger like a regulatory intervention, and that's just sort of like directly in the annual report. And so that shows that these activities are valuable. Now again, is that sort of like efficient or not? That's a separate discussion.
But if you were to look at, say, Kansas City Life's disclosures, would you say, they're doing things right? They seem to manage the crises both times.
So I think the key sort of like things to look at is like what kind of guarantees they've underwritten, which I know in the paper Moto we'll talk about now, we've built together like a large database on variable annuity guarantees. So that would sort of give you a good sense in terms of like the risk mismatch that's there, combined with the information that you have on shadow insurance. Like the securities lending is like largely like shut down in terms of like the risk mismatch there. And so I think sort of like looking at those two would be the natural starting point to understand risk mismatch.
Thank you.
There's one more question in the chat. Richard, do you want to jump in and ask Ralph and Moto?
Yeah, I was just saying that effectively the government ends up as the insurer of last resort, and that doesn't seem to be coped with within these models, and that occurred in the financial crisis, and via various mechanisms. It also occurred during COVID with the need for QE and so on in that process as well. So what's your comment on that as a transmission mechanism?
Yes, as a transmission mechanism, so I think you're right to say that sort of like so far governments have stepped in various cases. I don't think we know what they would do in like a large scale event, but we've seen sort of like during the financial crisis in the US, like in the Netherlands and other places, they have stepped in, they have supported sort of the insurance sector, just like they've done with banks. So that is certainly a concern. And that kind of goes back to the earlier like conversation with Alexi, is that I think like the way I would view it is that so there's a clear demand for these kinds of products. We want sort of like have someone to offer those products, but then the question is like, what is the regulation that goes with that, so that we shouldn't have to rely on the government to sort of like bail them out, and what is the prudent sort of like regulatory framework to safeguard those. And I think that's where we are like, we don't have enough, like nearly enough research, because you're dealing with like very long dated contract in an environment which is very uncertain. And so how do you think about sort of like developing long run valued risk constraints, proper like capital requirements, accounting for the fact that there is this strong demand for households for these kinds of products. And so I think that's sort of like a whole open like research agenda on how you do this optimal sort of like regulatory design, facing that uncertainty. I think that's like an extremely important question, but not something that we or others have answered. Thank you.
Okay, great. If there are no more questions right now, should we move on? Is Moto's part next?
Yep. Thank you, Alexi. Okay, so this is chapter 4 in the book Financial Economics of Insurance, which is based on work Ralph and I did that was published as the Fragility of Market Insurance in the Journal of Finance in 2022. And the key fact in this basically chapter is, as Ralph already mentioned, what you think of like this traditional insurance business, sort of like life insurance, health and accident, life annuities, those are actually still large, but actually smaller than the biggest part of their liability, which is this what's called a separate account or variable annuities. And variable annuities are essentially mutual funds that are sold through insurance companies. And when they're sold through insurance companies underwrite extra guarantees on top of the mutual fund. So think of these as mutual funds plus long-dated put options that are sold by insurance companies. And from a household's perspective, this insurance arrangement could have several functions. So one is if there's cross-section of households that have different degrees of risk aversion, this is a way to move market risk, the distribution of market risk across households through this variable annuity. So essentially, if you think about variable annuity holders, they're buying put options, and the shareholders of MetLife and other these publicly traded companies are writing put options. So it's a way to kind of move market risk around in a cross-section of households. The other function that this could provide is, as emphasized by work that Johan Humbert has done in the European context, is potentially intergenerational risk sharing, right? So the idea is that if you're born in a generation that has particularly poor stock returns, then your retirement income is going to be lower. But if you have like a long-lived financial institution, then these institutions can basically shift that market risk, smooth that market risk across generations. So that's theoretic foundations for that is like the Allen and Gill 1997 model. Okay, so with that kind of background, I wanted to talk about, well, how do insurers produce this type of insurance? So we prefer to think of these as different from traditional insurance, where bigger balance sheets are safer, because in traditional insurance, you're insuring idiosyncratic risk. So the bigger is the balance sheet, like the more diversification you achieve. But in this case, bigger balance sheets does not get rid of the risk, right? Because these are risks that load on market and credit risk and interest rate risk, right? Systematic sources of risk. And 35% of insurers' balance sheets are tied up in these types of contracts called variable annuities in the US. But more generally, these are minimum return guarantees, and there are products in Europe that kind of have similar features. So when insurers are insuring market risk, they do so imperfectly, right? So when they could have potential risk mismatch between assets, or they could potentially try to hedge these risks, but the hedge positions might be imperfect. So when markets go down or volatility increases, that could reduce the equity of these insurance companies, and consequently, these insurers that become constrained could behave in ways that are that reduce basically the supply of insurance. And there's various ways that can reduce supply. So one obvious one is, well, they can just simply increase the fees on these contracts and make it less accessible to investors or policyholders. And so higher fees, lower sales, like a classic shift in the supply curve. But a potentially different way to limit risk is they can change the contract features to be less exposed to risk, right? So I'll go through like the mechanics of what are called roll-up rates. These are basically guaranteed rates on these contracts. So they can reduce the guarantee rate. That's kind of equivalent to changing the strike price of a put option to make it less in the money. And then as a consequence of that, in extreme case, they can make these contracts basically so out of the money that essentially there is no guarantee. Right? So in extreme case, they exit the market by not providing these guarantees. And essentially, that's what they did after the global financial crisis. Some companies reduced guarantees on new contracts, or they entirely exited these markets, which is and so this could be like a new source of like the classic information theory of insurance markets say that adverse selection and moral hazard can cause insurance markets to be incomplete. That is, certain types of contracts or insurance may not be offered. And that's kind of coming from information frictions on the demand side. But the kind of similar phenomena could happen through the supply side, that when insurance companies get constrained, then that could itself reduce the supply and cause markets to become incomplete. Okay, so some of the important features of incomplete insurance markets could arise entirely from regulatory financial frictions, right, without information frictions. And as Ralph already talked about, there was an initial shock in 2008, 2009, but this shock kind of persisted for a decade afterwards, where you see like very sluggish recovery or never recovery in the variable annuity market. And this has to do with like the low interest rate environment. Okay, so in a low interest rate environment, these insurance companies become very constrained in terms of like the legacy guarantees that they have on their balance sheets, and that could have prevented these companies from issuing new contracts. So we'll discuss a model that can drive that type of behavior. So in terms of like the key regulation for understanding these contracts, it's what's called the RBC, or risk-based capital regulation. So the way these regulations work is that these regulations ensure that insurance companies have enough equity relative to the amount of equity that's required to deliver like a type of policy, with enough capital to be so that policyholders are paid in most states of the world. So it's like the ratio of equity to essentially like the size of the liabilities, or proportional to the size of the liabilities. Okay, so the numerator is assets minus reserves. Reserves are liabilities, so that's equity. Denominator is, think of it as like a fraction of liabilities. Okay, so it's proportional to the size of liabilities, and also the riskiness of liabilities. So the way variable annuities work is, well, when there's a shock, then required capital goes up, the denominator goes up, right? Because now these contracts are now in the money. So you need to set aside more capital to make sure that these contracts are paid. And moreover, some credit risk on their assets, or risk mismatch between their assets and liabilities, can cause equity itself to go down, right? So assets might be exposed to less duration than reserves, the liabilities, and that could cause itself equity in the numerator to also go down. Okay, so for both of those reasons, RBC tends to go down in bad times for these insurance companies. We're going to define what's called this reserve valuation, which is the ratio of liabilities, accounting value liabilities, reserves, to the total account value. So that's like the account value of the mutual funds that are underlying the variable annuity. So this is like a ratio that's less than 1, which is, think of it as per dollar of mutual funds, what is the value of the put option guarantee? In addition to RBC constraints, there could be an economic risk constraint or value at risk constraint, and this works very similarly to an RBC constraint. So the way this one works is an insurance company wants to make sure that its tail risk is bounded in a certain way, which is that the probability that the leverage liabilities to assets exceeds 1 is the probability that the liabilities exceed the assets, right, is the probability that it's solvent, the liabilities are less than the assets, is greater than or equal to a threshold kappa. So you can write it in terms of the probability distribution for the shock epsilon. So the current leverage ratio is liabilities to assets. There's a future shock epsilon to the leverage ratio. There's a distribution of that epsilon, which we write as F, as the cumulative distribution function. So the probability that assets and liabilities, the leverage ratio is less than 1, future leverage ratio less than 1 is bounded below by kappa. Okay, so we can rewrite this by inverting the probability CDF F as assets minus liabilities, equity relative to phi times liabilities, where phi is the inverse of the CDF, evaluated to kappa minus 1. So then this ratio has to be greater than or equal to 1. Okay, so a value at risk constraint ends up looking a lot like an RBC constraint, where the numerator is like essentially equity and the denominator is like a proportion of liabilities. Okay, so in that sense, like in terms of like functional form, like value at risk constraint might look very similar to an RBC constraint. Now, a key difference is this is constraint that could arise even in the absence of any regulations. So this could be like an internal risk constraint where an insurance company decides that it wants to like limit its risk exposure in order to stay solvent. So a more conservative insurance company with like better risk management would either choose a lower variance for epsilon, right, or a higher threshold kappa, right, for solvency. Okay, so we put together data on the variable annuity market, where this is one of those unique insurance markets where we observe essentially all the contracts. So like if you try to like gather data on term life insurance or life annuities, you might be able to cover like 40% of the market, but it's hard to get 100% coverage. But in the case of variable annuities, because these are essentially mutual funds, Morningstar has pretty complete coverage on the universe of these contracts. So Ralph and I put together data at the quarterly frequency based on Morningstar from 1999 to 2015. And we essentially observe at the contract level sales fees and other contract characteristics are relevant to the risk characteristics of these contracts. In addition, we observe at the insurer level, like the total value of variable annuities and the accounting value of the guarantees or the reserve value through what's called the general interrogatories, part 2, table 9.2. And in addition, we have the annual financial statements and the rating from the AM Best company. Okay, so one of the key features of the variable annuity market is that its sales before the crisis, its sales were highly correlated with mutual fund sales. Okay, so the dashed line is like plain vanilla mutual funds, which is on the right axis. So these are quarterly sales, like what you think of as like the mutual funds, right? And then on the right axis is sales of variable annuities. So these are mutual funds with potentially these that are sold by insurers with potentially these guarantees. So prior to the crisis, the quarterly sales are highly correlated across variable annuities and mutual funds. So they goes up and down together. Excuse me. And then post 2008, you see these things diverge, right? So you see that variable annuity sales kind of have a long run downward trend through 2015. And then mutual fund sales seem to recover post global financial crisis. So this is like kind of a first sign that says maybe there's something that happened during the crisis where the supply of insurance, these insurance contracts got shocked, and this shock was very like persistent over time. Okay, so the second piece of evidence is if you look at the number of insurance companies that are offering these contracts, so this was like what Ralph was referring to earlier as like a kind of like a war on guarantees, where like these insurers were vigorously competing for business prior to the global financial crisis. So the number of insurance groups that are offering these contracts kind of peaked around 33 in 2008, okay, right here. But since the crisis, right, the number of insurers and also the number of contracts rapidly kind of decline, and its decline is very persistent, and it doesn't seem to quite recover through 2015. Okay, so initially there was like a rush to get into this business, and then post-crisis, another rush to get out. If you look at the fees on these contracts, so the total height of the bars is the total fee, but the total fee is composed of the basic contract expense plus fee on the minimum return guarantee. Okay, and essentially like the total fee goes up post 2008, and it's mostly because the fee on the minimum return guarantee, so that's the put option part, goes up in 2008. And then the increase in fees in the order of like around 50 basis points. And then this increase in fees is kind of like, looks like a permanent shock. So once it gets to a higher level, it stays at that high level for quite some time.
Moto, can I ask real quick, with this fee, it's part of the markup, right? But it's not the whole markup. Do we have a sense of the markup on these products and how it varies?
Yeah. So in order to analyze the fees, what we can do is we can decompose the fee into like the kind of like the Black-Scholes like option value, like the frictionless option value. On top of that, there's like financial friction costs, like the cost of capital that comes from like the fact that capital is constrained and within an insurer. And on top of that, there's like a more traditional IO markup that comes from imperfect competition. So we can decompose it into those three parts. But that requires us to like estimate a demand system and then to do that decomposition. So that's coming kind of a little later in this talk.
Okay, but what you're saying is it would be part of the fee. It's not, the fee includes the markup, or am I
Yeah,
misunderstanding?
the fee includes that markup. That's
And this
right.
is like per year of account value.
This is the annual fee per dollar of account value.
Okay, so like compared to mutual funds, or index funds or something, this is like super high.
Super high, and keep in mind that they're already charging fees on the underlying mutual fund. So
Okay,
it's like fee on top of fees, right? So like the underlying mutual fund might be like an 80-20 fund.
yeah.
And that's already charging like 80 basis points. And on top of that, the insurance company charges 2.5%, like 2.3%.
Wow.
Okay, so this is the a picture on the roll-up rate. So the roll-up rate is like the minimum rate that they guarantee per year. So the way it works is like if the stock market goes down, right, you get an increase in your account value equal to at least the roll-up rate. So think of this as like the minimum floor guaranteed rate. And so this dark line is the average roll-up rate through the years, and you can see like competition seems to like have increased the roll-up rate up to the financial crisis, and then post financial crisis, it eventually declines back to like around 3%. But it peaked around 5%, kind of right at the financial crisis. And then on the extensive margin, not all companies are offering these guarantees. So the share of contracts with these guarantees also peaked around 2008, but there was like a rapid exit from these guarantees where insurers can still offer these variable annuities without guarantees. In that case, essentially these become potentially tax advantage mutual funds that are still sold through insurers, but doesn't have this guarantee feature. And then so like the share of contracts that have minimum guarantees actually peaked around like almost 40%. But like after global financial crisis, it went down to like more like 20%. Okay, so based on like these key facts, we set up a model that can like deliver these facts. And the way we set up the model is we first model like an insurance company that's subject to financial frictions. And then there's like a cross section of insurance companies that compete by Bertrand pricing. So then you get imperfect competition and markups. And then we can do like a comparative static where these insurance companies get shocked because the value of their existing products goes up. And then when that happens, we can analyze what happens to how they price the new contracts in terms of the fees and in terms of the contract characteristics, and in particular the roll-up rate. And then we also allow these companies to essentially exit the market for guarantees by offering irrelevantly low roll-up rates. Okay. So let me just explain the setup, and I think things will become more clear. So think of a financial market like a stock index. S that involves exogenously. So like S could be like S&P 500 index. And then this is priced in the usual way where the price. So we're assuming a way there's no dividend payments. These are just contracts without dividends. S is the stock price is equal to the expectation of the SDF times the future stock price. A variable annuity in period T is going to be a 2-period variable annuity. And then in a few slides, it's going to be clear why we modeled these as 2-period contracts. The fee is P per $1 of account value. Okay, so like in a frictionless market, P should be just the option price, right? And then there's like a roll-up rate R, which is the minimum guaranteed rate per year. So the payoff of a variable annuity guarantee is the following, which is you get the maximum of 1 plus the roll-up rate compounded over 2 years minus the actual return on the stock market and 0. Okay, so the option value is the present value of the payoff. So VTT is at time t, what is the price of an option that was issued at time t. Okay, so the double index TT stands for the first index is like current time, and the second index is when the contract was issued. Oh, sorry, the first index is when the contract was issued, and then the second index is the actual time. Right. So for example, XT T plus 2 is XT means the contract was issued at T, and then the right, and then the payoff occurs at T plus 2. Okay. So the variable annuity is a mutual fund. Special case of the variable annuity is it's a plain vanilla mutual fund when the roll-up rate is -1, right? Because in that case, in all states of the world, the guarantee will be worthless. So that then this becomes a plain vanilla mutual fund. So we can model like an insurer exiting the market for guarantees by choosing R equal to -1. Okay, so that's like a potential outcome of the model. Okay, so the way the balance sheets work is what we call the separate accounts is the mutual funds, right? So the mutual funds account value, BT, this is the account value of the mutual funds at time t. And then the mutual fund part of variable annuities is like assets is exactly equal to liabilities. So it's like an all equity claim. That is, if I buy $1 of mutual funds, right, through an insurer, right, if that goes up to 1.1, then right, the liability and the assets both go up to 1.1. And that is, a mutual fund is like a full equity claim. Now, what is not an equity claim is the guarantee on top of the mutual fund. And the way that works is that's going to be part of what's called a general account. And the general account has assets and liabilities, and assets minus liabilities is equal to the equity. Okay, so generally, like when we talk about insurance companies' assets and liabilities, we talk about the sum of A plus B versus the sum of B plus L. But it's important to like keep track of like what's in the separate account versus the general account, because what's in the separate account is in theory, there's no like risk mismatch there. It's like customers own mutual funds, right? And then it's an all, right? For each dollar that the customer owns in mutual funds, right, their assets are exactly equal to liabilities in all states. Now, on top of that, the insurance company underwrites guarantees, which is in the general account. And that's where the insurance companies are potentially taking on risk, because if they underwrite a guarantee, that's a liability L, and there's risk mismatch in terms of like what assets they hold to back that guarantee A, then the risk mismatch between A and L can cause like the insurance company's equity position to fluctuate over time. So the account value is right, just the mutual fund part. So if you have today's mutual fund value B, that earns a rate of return S over ST over ST minus 1. That's the rate of return on the mutual fund. Plus Q is the new sales of mutual funds. Then that gives you the new account value B. In terms of the general account assets, insurance companies collect the fee equal to P per dollar of account value. So P times Q is the total fees they collect on the variable annuity. And then they have some legacy assets that accumulate at the rate of return RA, and that gives you the new position A. On the liability side, right, the value of the market value of the new guarantees they underwrite is VTT, that's the option value, times Q, that's the quantity. And then they also have some legacy liabilities that accumulate at the rate of return that's equal to the change in the option value of these guarantees. Okay. So we're going to model the risk-based capital as equity minus required capital. So relative to what I showed you earlier, like in a few slides ago, recall that risk-based capital was a ratio of equity to required capital. So here, instead of a ratio, we're doing it as a difference, just so that the first order conditions pop out more nicely. But you can always do it as a ratio. For example, we can divide this by like LT minus 1, and then first order conditions won't change. You can think of phi t here as risk weight on liabilities, where the more generous are the guarantees, or the riskier the guarantees, the higher is the phi. Okay, so phi is increasing in the riskiness of the liabilities. Okay, so think of an extreme case where the guarantees are just, there are no guarantees and these are just mutual funds, then phi should in theory be 0. Right? And then the insurer doesn't have to set aside extra capital, right? But if the guarantees are risky, then right, phi is positive, they have to set aside extra capital. Okay. So the way we're going to model financial frictions is the cost of, there's a convex cost associated with low levels of capital. So we're going to model as like a function C of risk-based capital K, where C is decreasing and convex. Okay, so we define the shadow cost of capital as lambda is equal to little c is the first derivative of the cost function, and this lambda is greater than 1. Okay, so higher is the lambda, the higher is the cost of capital. So when k is low, capital is scarce, that causes L to be high. You can also get a high shadow cost of capital because phi, the riskiness of your liabilities, is high. So it's a combination of how much capital you have and the riskiness of your liabilities, right? Where higher lambda means like more risky liabilities, and lower levels of capital, you're more constrained. Okay, so remember these are like 2-period contracts, and then this kind of figure explains why we set it up as 2-period contracts. So the way this works is I issue some contracts at t-1, and the value of this option that I issued at t-1 is going to change at time t because, right, interest rates change or volatility shocks happen. Okay, so vt-1t is at time t, what is the value of options that I issued at t-1? Okay, but because these are 2-period contracts, they're going to be overlapping. So I'm also issuing new contracts at time t. So VTT is contracts that I issue at time t, evaluated at, right, the state variables at time t. And then these contracts are going to have a different value at t+1 because, again, like interest rates change and like shocks happen. Okay, so the reason like these contracts are well, so in a frictionless model, like the pricing of these contracts shouldn't be related. But in a model with frictions, they're going to be related because like a shock to products I sold in the past. So like if this goes up, I become more constrained. That could affect the pricing of like the new contracts at time t. Okay, so there's going to be like a relation between the shocks that happen at t, which changes the value of the legacy products that are on my balance sheet, and that could affect the pricing of new products.
Moto, can I ask real quick? In the graph you showed a few slides ago, it seemed like the sales really like increased during 2008 of these annuities. I'm just wondering if that means, how would you explain that here? Like if their cost had gone up, you know, for regulatory and other reasons, the sales probably wouldn't have. So it must mean there was like a surge in demand or something like this that happened.
So this is this the figure, Alexi?
Yeah,
so,
this is the figure. I'm trying to fit it into what you were just talking about, which was saying that it's costlier to provide, and yet the amounts are growing.
Oh, sorry. So what we're claiming is that the sales are decreasing. So it peaked before the crisis here.
Oh, okay.
It, excuse me, and it decreased in 2008, 2009 here.
Gotcha. Okay.
Yeah.
Thanks.
Okay, so the way like the model's going to work is there's a shock at time t that makes the value of my existing liabilities higher. It's going to lower risk-based capital K at time t. So, right, and by the convexity of the function C, that's going to make the cost of capital higher. That's going to increase lambda at time t. And ultimately, that's going to feed into the pricing of VTT or contracts that are issued at time t. Okay. So let's set up this as a proper insurance company's maximization problem. So we're going to model the demand side for now very simply as there's some kind of demand function that depends on the fee P and the roll-up rate R. And the natural assumption is that demand is decreasing in the fee and increasing in the roll-up rate. In order to kind of capture the range of roll-up rates that we see in the data, we're going to limit the range of roll-up rates to like essentially between positive or -1. Right? So in the data, we don't see like negative roll-up rates. And in theory, you could have negative roll-up rates, but maybe like for psychological reasons, like that's not attractive to consumers. So the way we model that is that's not in the choice set. So the choice set is I can offer contracts with positive roll-up rates, or I can choose -1, which is essentially a contract with no guarantees. The insurer basically has two choice variables. The insurer can choose the fee and the roll-up rate. So like kind of like an option pricing logic, this is like as if you can choose the moneyness of the option, right? Is essentially like what R controls, right? Because by making R very low, or in the extreme case -1, you make it like totally out of the money. Okay, so P minus V is the profits that occur to the insurance company per contract. Q is the quantity, and C is a function of K, which is the cost of financial frictions. So when you take the first order conditions, you get the standard like kind of IO Bertrand pricing formula where the fee is equal to 1 over the semi-elasticity of demand plus marginal cost. Marginal cost is this cost of financial frictions lambda times the frictionless option value V. Okay, so in the special case where like insurance companies are not constrained, lambda is equal to 1. So then you get essentially the Black-Scholes kind of frictionless option value VTT plus just the markup that comes from imperfect competition. Okay, but in the general case, like lambda is greater than 1 if these capital constraints matter. And that can cause the fee to be greater than the frictionless option value V. Okay, so how about the optimal condition for the roll-up rate? So the roll-up rate satisfies if it's an interior optimum, that is a roll-up rate between 0 and infinity, then the optimal condition is an interior condition that says this elasticity with respect to the roll-up rate, that's the numerator here, ER, divided by the elasticity with respect to the fee, the denominator, is equal to lambda, right, the cost of financial frictions, times the first derivative of the option value with respect to the roll-up rate. Okay, and then otherwise, at a corner solution, the insurer could choose R equal to -1 as the optimum. Okay, so if we look at this formula here, and let's pretend that the left-hand side is constant, which would be for like certain classes of demand functions, the left-hand side is constant, for example, the logit demand function. Then basically this says that when lambda is high, then the insurer has to set R lower. Right? So there's a trade-off between the cost of financial frictions and the optimal roll-up rate, right? Where the logic is if the insurer is like very constrained, capital scarce, then it cannot issue contracts that are like capital intensive. Okay, so the way it reduces the risk is essentially like when lambda is high, then it has to choose like a lower roll-up rate. Okay, so that's how the first order condition works. Is lambda high, you want to set DVDR low by choosing a lower roll-up rate. And in the extreme case, like this first order condition won't hold, and the insurer wants to choose a corner solution -1. So this is like an example of right a model where not only are the fees, but the contract features are chosen endogenously by the insurance company based on like financial frictions. Right. So the classic kind of like logic in corporate finance is, well, if banks get constrained, they just simply raise the mortgage rates, right, or the loan rates. And as a consequence, in equilibrium, you observe like lower equilibrium quantities of loans. And that's certainly true here too. But there's like another channel here. Like not only are they potentially raising fees, but independently, they could also be like changing contract features to make them safer, essentially, or less capital intensive. And in an extreme case, they can like exit these contracts that have these guarantees. So that's like a novel feature of this model is like there's two choice variables, contract design and also fees. Okay, so yep, go ahead.
Two things. One is we had a question in the chat, and two is if I was wondering if this would be a natural place to take a break, which we often do around 10:30.
Oh yeah, right.
But
yeah.
It's up to you. The question in the chat is from Matt. He's been very patiently waiting. Matt, do you want to jump in?
Sure. I thank you again, Moto. Thanks. Nice job. Hey, I'm looking at your slide number 10, and you know your study cuts off at the end of 14. And my question is just simply, we saw this run up in MRGs through 2008, and then this decline through 15. Did we see a run up again through 2020, and then a decline again following the crisis? And my question is, you know, do these insurance companies not learn, or, you know, being a little silly, of course, but, you know, are we just seeing repeat behavior, right? They chase their tail until they can't again.
Yeah, that's a great question. So we haven't updated this particular data on contracts after 2015. So that would be very interesting to look at to see what happened. Now, Ralph was showing like stock returns of these insurers through the COVID crisis. And he was showing that like the companies that had low returns during the global financial crisis also had low returns during COVID. And that's just coming from the fact that these contracts that they sold back in like 2006, 2007, like way long ago, these are like very long dated contracts. So they kind of stick around for many, like over decades. So even if they hadn't sold new contracts, like these risks actually persist. But like a separate issue I think you're pointing to is like, well, does that mean that these companies have learned their lesson and not selling anymore? And that would be like certainly interesting to test. I think there's room to do more work here. Yeah, quite a bit of stuff that happened since 2015. It'd be like very interesting to update the data.
Thank you.
Okay, great. Yeah, let's take a 10-minute break, Alexi. Does that sound good?
That sounds great. We'll be
Okay,
back.
thank you.
10:45, everyone. Thanks, Moto.
Thank you. Market shares and contract characteristics. Okay, so we're going to describe how this works, and then we'll do like an estimation of this. So the way this works is we assume that the consumer chooses one of the contracts, variable annuity contracts, or can choose an outside asset. So that could be like investment in plain vanilla mutual funds if they don't go with one of the variable annuity contracts. And they get an indirect utility from choosing contract I that depends on the fee, P, roll-up rate R, other contract characteristics X, where X is a vector, unobserved characteristic Xi, and a logit error epsilon. Okay, so this logit error epsilon is drawn from a type 1 extreme value distribution. So that implies that the probability that the customer chooses contract I is going to be QIT, where it's a logit formula. Okay, so it's the exponential of linear combination of fees, roll-up rates, contract characteristics, and the unobserved characteristics Xi divided by 1 for the outside asset plus the sum of all the options. And the reason this is random coefficients is we're assuming that the price elasticity coefficient alpha p is drawn from a log normal distribution. So think of it as different consumers have different price elasticities that are drawn from that distribution. So in order to compute the market shares, we have to integrate over the consumer types. So the way we do that is conditional on realized alpha p. Then the probability of choosing contract I is QI. And we integrate over that distribution alpha p, and that gives us the market share for contract I. So big QI is the market share for contract I at time t. And once we do that, we can compute the semi-elasticity of demand very easily by differentiating Q with respect to P. And we get this formula here. This random coefficients logit model implies more realistic substitution patterns than like the regular logit model, where in the regular logit model, the substitution is always proportional to the market share, right? But this random coefficients allow for like more sophisticated forms of substitution, where essentially consumers substitute into contract with similar characteristics. Okay. So the random coefficients logit model is estimated by GMM, where the identifying assumption is that these unobserved characteristics X, conditional on the observed characteristics X and some instrument Z, the conditional expectation is equal to 0. And then this Xi is not exactly analytical, but it can be evaluated very simply through numerical simulation, and that's what we do. So we like draw a distribution for the price elasticity coefficient from a log normal distribution, and then we integrate over that distribution to compute market shares at the given parameter values, and then we update the parameter values in the GMM formula. Okay, so in the interest of time, we don't quite have enough time to go through that in great detail, but that estimation technique is well known in IO, but it's also like described in detail in our book. If you'd like to read chapter 4 of our book, where it's explained step by step. Okay, so to implement this demand estimation, we have to choose the contract characteristics. The key contract characteristics are fees and roll-up rates. In addition, the number of investment options. So each contract could have like different mutual funds that you can choose from. Like it could be like an 80-20 fund or a 50-50 fund and so on, in terms of like mix between equity and fixed income. So like the number of different options, a dummy variable for GLWB, which stands for the guaranteed living withdrawal benefit, which is the most generous type of guarantee. And then we also have dummies for share class fixed effects. Now the share classes are potentially very important because this share class is an indication of how these contracts are distributed. So for example, like share class B has no surrender charges, but no sales charges, and share class I has no commissions. And these are typically like directly sold variable annuities that don't go through investment advisors. So there's actually potential room for doing like future research on this, which is to do a more proper demand system that takes into account like the incentives of brokers and how different types of contract and share classes are distributed, like sometimes through brokers or investment advisors, sometimes through direct sales, and so on. Some of them is like could be even internet sales and so on. But these types of details are not quite something that we do today, but it could be like a very interesting topic for future research. In terms of insurer characteristics, the obvious ones are like AM Best rating, and we also have insurer fixed effects. And then the outside asset is like the normal mutual funds. In terms of instruments, we need at least two instruments because we have two endogenous variables, the fee and the roll-up rate. And then our assumption is that the reserve valuation, this is the accounting value of the guarantees, and the share of variable annuities that are reinsured. These are things that are correlated with the cost of variable annuities, but are assumed to be exogenous for our purposes. So to motivate the first instrument reserve valuation, the way like the accounting value of these liabilities are calculated is through this accounting rule called AG, Actuarial Guideline 43, AG 43. So what they do is they do like a simulation, and then they take the 30% conditional tail expectation. So like the average of the lowest 30% of scenarios in terms of like equity, or right, or the highest values of liabilities relative to assets. Okay, so then they try to come up with like a conservative valuation of these liabilities based on this 30% rule, tail rule. And then the way they do this simulation is not using necessarily like market values, but like this is our accounting formula. So there's a discrepancy between like the value of these reserves in accounting terms and the actual market values that policyholders may care about. Okay, so that could plausibly lead to like variation in this reserve valuation across insurance companies that are selling different types of contracts that could be used for identification. In terms of like reinsurance, most of the reinsurance, as Ralph discussed earlier, is like this off-balance sheet shadow insurance. And to the extent that policyholders look at ratings, but not necessarily know about like which companies are doing like much more shadow insurance and so on, that could be like exogenous from the perspective of policyholders. It might not be information that they're conditioning their demand on. So these are potentially strong assumptions, but these are sufficient for identification. Okay, so we estimate the coefficients on the fee, the roll-up rate, and the other contract characteristics. And we have like a large panel of contracts, 32,000 observations in total. And then we're allowing the random coefficient on the fee, which gives rise to the standard deviation estimate. So 0.3 is the standard deviation around the mean, describing the random coefficient on the fee. So in principle, you can allow random coefficients on the other contract characteristics, including the roll-up rate, investment options, and so on. But in practice, it's kind of hard to identify lots of random coefficients with limited amounts of data. So this is like by trial and error. You can try to see if you can identify more random coefficients, but in practice, it's hard to do so. Okay.
Moto, can I just ask real quick, the positive coefficient on fee, is that surprising, or do you think it's picking up something about quality? Like this is saying that,
Oh, sorry. It's we have a negative here.
oh man, okay.
Yeah. So
Yes.
sorry. So yeah. So that means that demand is when fee increases, demand decreases.
Okay, but the regression was, yeah, Q on fee. Okay, so maybe you should
Actually, yeah, the notation here
yeah, there's a
is
negative
consistent.
there.
Yeah, so this negative. So we're reporting alpha p, but there's a negative in front of alpha p.
It's the coefficient on like the negative of the
Yeah.
okay. And the share classes and things like that, does it make sense? Are you saying that financial advisors kind of like contribute to, all else equal?
Yeah, increasing the demand, right? Because the iShare class is the one without these commissions.
Negative, sharply
And
negative.
then yeah, and then it has the very negative demand. Yeah.
Gotcha. And the roll-up rate, like that means if I have a 1% higher roll-up rate, my market share, does it go up a lot? Is that a big coefficient there? Like, do people really value these roll-up rates according to this? It's highly significant. I'm just wondering.
Goes up. Demand goes up by 18% per.
Sounds like a lot. Okay.
Yeah. So that's like saying like. Yeah, like if I sell.
I guarantee you 6% instead of 5%.
50 million a year increased my demand by 10 million, right? Almost, yeah.
Yeah. People really like this stuff. It sounds like the roll-up rate.
Yeah, yeah. There demand seems very elastic to the roll-up rate.
Yeah.
Very good. Thank you, Alexi. So we take the first order conditions for the fee, the first equation, and then the roll-up rate in the second equation, where we introduce this omega greater than or equal to 0. So when omega is equal to 0, the roll-up rate, so if you recall the roll-up rate first order condition is this one here. So at an interior optimum, right, this equation is true, but when in a corner solution, this doesn't hold. So we introduce this omega, so that when omega is equal to 0, you have an interior solution, and a corner solutions model as a positive omega. Okay, and then kind of graphically, like we can illustrate like the difference between an interior solution and a corner solution as the following. So in an interior solution, right, the relative demand elasticities is exactly equal to lambda times dVdr. And that could happen at like a roll-up rate of 0.1. Okay, but if there is no like roll-up rate at which, a positive roll-up rate at which that the equation holds, then right, that could happen at a negative roll-up rate. But in that case, because the insurer cannot choose a negative roll-up rate, then it chooses a corner solution instead at -1. And this omega is the distance between that line and 0. So that's like the degree to which this equation does not hold, and at the corner solution roll-up rate of -1. Okay, so we make some parametric assumptions about the option value. So here, like you might be slightly confused for the following reason, which is if you could like compute the option value like using like option pricing formula, then wouldn't you do so? And then answer is absolutely. But here, it's not as easy as you think for the following reason, which is these are like very long dated options. So it's hard to come up with like replication strategies where you using like exchange traded options to replicate these contracts. So like kind of replication is not as easy as you think. And these are like very long dated contracts, which depend on long run volatility. And if anything, like this is like a should be an active area of research, and we're not quite at the level where we feel comfortable enough to say like, well, we have a very good model, like long run volatility that we can estimate. So we took like kind of like a more reduced form approach, and certainly like this could be improved upon in future work. And the way we do this is just simply posit that the option value V is going to be just a function of the contract characteristics Y and the roll-up rate R. And then when we differentiate V with respect to the roll-up rate, dVdr, which shows up in the optimality condition for the roll-up rate, then this itself is going to be like a function of contract characteristics Y and then the option value V. Okay, so once we like assume this parametric, make these parametric assumptions, then it's just a matter of estimating these coefficients, little delta and big delta. And then similarly, the shadow cost of capital lambda is going to be just a, this is like only varies across insurers, but not across contracts. Okay, so this only depends on insurer characteristics Zn and insurer fixed effects. Okay, so we can set this up as like a big moment condition and estimate that by GMM. And because the roll-up rate has this corner solution feature, instead of moment equalities, you get what are essentially moment inequalities, which you can transform into moment inequalities by introducing like these additional incidental parameters, omega, big omega. So when we estimate, oh, go ahead.
Is this these contract characteristics they're fixed, or is there room in there for some kind of volatility shocks, or is implicitly like volatility assumed constant? Because what's in the Y, like could that jump up in the financial crisis or not? I know it's very long term, so
yeah,
it seems like you need to take a stance.
So so the answer is we actually don't allow these coefficients delta to be time varying. Now that you mentioned that, one way we could do this is to introduce like time fixed effects and or interact right time and these contract characteristics Y.
Would you be able to identify that still?
It might not be like enough data to identify it very accurately. So what we ended up doing is we have the number of investment options and guaranteed living withdrawal benefit dummy. These are like the key contract characteristics. And then we also had the share class dummies. And trying to remember like exactly what we did, because if that's true, then this shouldn't be YINT, right? Because it's indexed by T. Oh no, that's fine, right? Because these, yeah. So the degree to which it's time varying is the following: is these contract characteristics themselves are changing over time. So like the way you would capture like periods of high volatility is that these insurance companies like might offer might change the contract features in response to the volatility, and that could capture it to some extent. But to like kind of like capture what you have in mind, I believe you do need like time fixed effects.
Yeah.
As well as interactions at time with these contract characteristics.
Yeah.
Okay.
It's striking how the fees, I mean, there's like a jump up after 2008, but otherwise they look very stable. And you would think that, in general, like option prices are very volatile. These are long dated, so we don't know exactly how volatile they are. But it is striking how stable the fees are when it seems like the cost might be moving around quite a bit.
Yeah. So this is like the output of the estimation exercise, which speaks to what you're what you're talking about now, which is what we do observe, like the hard data is just the total fee, which is the total length of this bar. Right, so this figure is exactly the same as like our earlier figure on fees. And now we're decomposing that total fee into like different parts, where the option value is this first part, and then the second part is the shadow cost, and then the third part is the markup. So what we can tell is that the markup is like essentially like very constant over time. The option value does increase a little bit during the global financial crisis, and so does the shadow cost of capital. So in other words, like option value increase, like volatility increase, lower interest rates for a prolonged period. These contracts are like more expensive, even in the frictionless model. But on top of that, you have like these constraints that are more binding post-crisis, and that contributing to like a higher overall fee. So it's a combination of option value and the shadow cost. So if you look at the roll-up rate, we can decompose the roll-up rate optimality condition using this. We decompose using this equation, right? So when we observe the roll-up rate decreasing, or insurance companies not offering contracts with roll-up rate, that's essentially like, right, reducing DVDR, that is the sensitivity of option value to the roll-up rate. This is decreasing, right, post-crisis, roll-up rates decreasing. Or when insurance companies choose contracts that are with roll-up rate -1, that is contracts with no guarantees, that's like this omega becoming very positive, right, from 0. Okay, so omega is increasing post-crisis, right? More insurers are choosing the corner solution, or they're reducing roll-up rates. DVDR is decreasing. The shadow cost lambda is increasing post-crisis, and it turns out that from our demand estimation, this is like less obvious, but from our demand estimation, we can tell that the relative elasticities to the roll-up rate divided by elasticity to the fee, this one increased post-crisis because essentially the consumers became less price elastic. So epsilon P decreased, which caused the ratio of epsilon R to epsilon P to increase. Okay, so you can see like these various parts. This is like a cross-sectional average at each point in time. You can see that relative elasticities increased, shadow cost increased, and then the constraint on the roll-up rates like more binding post-crisis. So this is like very positive. And then they're decreasing the roll-up rate. So DVDR is like decreasing over time. Okay, so that's how, like at each point in time, that right, this equation satisfied. But what we can tell from this decomposition is like which parts of that equation is causing most of the movements, right, in that first order condition. Well, relative demand elasticity seem important, but so is like the constraint on the roll-up rate. So like lots of companies are deciding that they want to lower roll-up rates to the point where they actually need to exit these markets. Okay, so I'm almost out of time. So let me just quickly summarize, and then I'll pass it on to Ralph, who's going to cover the next section. So kind of like if you think about like the insurance models you learn in undergrad econ or graduate economics, like we typically come away with a view of like the Rothschild-Stiglitz view of the insurance markets, right? Where the key products that insure are like life and health risks, which are idiosyncratic, where the key frictions are informational frictions that lead to higher prices or incomplete contracts. And that Rothschild-Stiglitz model is like very much ingrained in like how people think about insurance, to the extent that most of the empirical literature on insurance markets is like various tests of that model. But after this like chapter, what we learned is that, well, there's a very different way to look at insurance markets where, well, the types of products that these companies are selling aren't so much idiosyncratic risk anymore, but could be loading on market risk. So these are financial market risks, such as duration and credit risk, stock market risk. And because this is like the biggest part of their balance sheet, right, we need like a different view or model of insurance markets where financial and regulatory frictions and market power, imperfect competition, are key sources of frictions that lead to various interesting phenomena in these insurance markets, where you see like big swings in prices, big changes in contract characteristics, and in an extreme case, insurance companies exiting. So we think like this model could apply to other contexts where there are big risks that are hard to diversify. So like flood insurance, cyber risks, long-term care insurance. These are markets where this type of model could be useful in describing like how those markets operate. And so like putting together data and then analyzing those markets from this perspective could be like very interesting for future work. Thank you very much.
Okay, great. Are there any questions at the moment? Anyone want to jump in? If not, Ralph, are you
Yep, I'm ready.
up next?
Yes. So let me make this a bit larger. Okay, so we're going to switch gears a little bit. So we focused so far a lot on risk mismatch and sort of understanding sort of the liabilities. What we'll do now is to focus on the asset side of the balance sheet and think about sort of the role of insurance companies in broader financial markets. And so the background here is the following: is that I'm sure many of you are familiar with like the growing sort of like literature on intermediary asset pricing. Kind of like in part starting from the observation that at this point, like most financial assets are intermediated by banks, insurance companies, pension funds, and so on. And sort of the traditional like frictionless view is that those institutions are simply sort of like directing the capital in the way that households wanted to do it anyways. And so, and if not, then households would switch like by buying different like funds or going to a different insurance company. And so like really any sort of intermediation frictions are kind of like irrelevant for asset pricing. And I think we've learned like through the financial crisis and part already before then, is that sort of these intermediation frictions are potentially quite important. And so we know that institutions, they face all kinds of constraints, like related to like leverage constraints, like insurance companies, risk-based capital constraints, VER constraints. And so we want to understand the impact of that on asset prices. Okay. And so we're going to focus, of course, on insurance companies here, and in particular on their role in corporate bond markets. And I think this picture is an important one to sort of like keep in mind, and that is that insurance, just sort of like who owns corporate bonds over time, starting in the post-war period. And what you see is that this bottom area, the largest area, those are like insurance companies. And so if you want to understand sort of like corporate bond markets, it's hard not to sort of like start by thinking about insurance companies. Now, they were even more important actually, like right after Second World War, where their share was like 60% and it's been gradually declining, but it's still very large at like 40% of the market. Now, the segment that's been growing a lot and that has received a lot of attention is mutual funds, which is this area over here. Okay, and so so we want to sort of understand like how do we think about insurance companies owning corporate bonds. Now, one aspect that's important and that's been sort of like highlighted in the intermediary asset pricing literature is sort of the importance of leverage constraints. And as we've talked about several times already, is that the leverage of insurance companies is very high. And so what you see over here is the leverage ratio first of property and casualty insurers. So this is the ratio of liabilities to assets. For P&C companies, it's a bit lower. One of the reasons being that they face these occasional like disasters, like hurricanes and things like that. And so they're operating with like a larger buffer. But if you go to life insurance companies over here, you see that their leverage ratio is very high, actually very similar to banks. It's been trending down a little bit, sort of like starting in the 90s, perhaps because they moved into variable annuities. But then it spiked during the financial crisis, and so these constraints are binding. We've argued that sort of with a low rate environment that has put more stress on insurance companies as well, and so we want to understand sort of like the role of insurers in corporate bond markets, and sort of like our starting point is the following: is that it seems that like households are willing to pay call it the convenience yield to insure idiosyncratic risk. That's kind of like the benefit that insurance companies provide. And perhaps also on top of that, sort of these long-term return guarantees. Now, what that provides to insurance companies is cheap access to leverage through their underwriting activities. Okay. Now, compared to other institutional investors that face like leverage constraints, insurance companies are essentially able to borrow below the rate at which other investors are able to lever up. And so in response, they may sort of like use this leverage and start buying sort of like lower beta assets. And so that very much builds on the work of like Black and more recently Frazzini and Pedersen. And so we're going to think of a model along those lines. Now, to sort of like provide some sort of like first evidence on this final point, let's sort of dig into like what kind of corporate bonds insurance companies hold or what their broader portfolio looks like. So here you see on the left-hand side, the portfolio composition of life insurance companies, and on the right-hand side of P&C companies. And so if you look at this top area over here for life insurance companies, and this like broad area over here, those are corporate bonds. And so you see that the majority of their assets are invested in corporate bonds. And we'll argue later that actually sort of poses a bit of a puzzle. Because like it's not very obvious why life insurance companies wouldn't simply hold treasuries and why they start holding corporate bonds. Because the fraction that they hold in treasury and agency bonds, which is this like small area here at the bottom, is really, really very small. Okay, so the majority of their portfolio is in corporate bonds. If you look at P&C companies, they also invest a significant fraction in corporate bonds. They used to hold more treasuries, but that's been going down. And they also invest a lot in municipal bonds, which is kind of this area over here. Okay, so first takeaway is that large fraction of the portfolio is invested in corporate bonds. Now, what kinds of corporate bonds? And here regulation starts to play an important role, very much sort of like in line with the intermediary asset pricing literature. The way sort of the regulation works is that like different bonds, different securities are assigned different like NAIC like risk buckets. And so the safest one are government bonds. They don't get any capital charge. If you then go to the safest corporate bonds, like AAA, AA, single A, then those get a capital charge of 0.3%. NAIC category 2, which are like the BBB bonds, which is a segment that's been growing a lot, they get a risk charge that's more than 3 times as high. And then you see that the capital charges like quickly escalate. Okay, and so that means that if you're kind of a constrained insurance company and let's say a bond gets downgraded, then that suddenly becomes much more capital intensive for you to hold that bond. Okay, and so we'll sort of like explore those questions later on. But the key thing is that sort of there are these like risk weights on the asset side of the balance sheet, and that makes that has an impact on the optimal allocation for insurance companies. Now, how did the allocation change over time? So what you see over here is the fraction of the portfolio invested in bonds with NAIC category 1 designation, NAIC category 2, and NAIC category 3 to 6. So we also plot like the market portfolio. And so what you see for the safest bonds, that life insurance companies pretty much follow the market portfolio, but P&C companies, they tend to hold like these safer bonds. If it comes to NAIC category 2, which is the BBB segment of the market, you see that sort of like in general has been trending up over time, just the market portfolio. But life insurance companies sort of like hold a disproportionately large fraction of those bonds. If you go to the riskier corporate bonds, you see that those are underweighted by insurance companies. Okay, and so the mental picture that sort of emerges is that they're the largest investor in corporate bond markets, but they tend to hold like safer corporate bonds, with P&C companies buying NAIC category 1 bonds and life insurance companies, NAIC category 2 bonds, and the riskier bonds they're leaving for other investors to hold. Okay. And so that's sort of like what's summarized over here. Fact number one is that insurers hold more corporate bonds than treasuries. Within corporate bonds, life insurers tilt to like NAIC category 2. P&C companies tilt towards NAIC category 1. And then one fact that I didn't show you, but we show in our book, is that this actually leaves a duration gap because corporate bonds tend to have shorter duration than treasuries. And so by tilting away from treasuries to corporate bonds, which also creates like credit mismatch, they also sort of like incur this additional duration gap. Okay. And so does sort of like standard theory predict that insurance companies should hold corporate bonds? Okay, so just taking the plain vanilla model, like, is it obvious that we see this kind of like portfolio holdings? And we think it's kind of an important question to understand why the largest investor in corporate bonds holds corporate bonds in the first place. And it turns out that the answer is a bit surprising. So suppose you start from the following like very basic optimization problem, which is that the insurance company gets some premiums today and it's going to invest it in financial markets. And so there's like some stochastic discount factor M. It's going to have its assets sort of like next period. And then there's some like regulatory cost depending on the portfolio XI that the insurance company chooses. Now there's an intertemporal budget constraint that says like, okay, you start with premiums today plus your own equity. You invest that in different assets and outcome your assets next period. Now, the risk-based capital regulation that I just showed you tells you that if you hold riskier corporate bonds, then those require a higher capital charge. And so that's more costly for you to hold. Now, then the very simple, like following logic, it implies that there's a bit of a portfolio puzzle. The return on any asset, whatever asset the insurance company invests in, if you assume that markets are efficient, meaning that MetLife does not have like any special alpha, the price of any return is equal to 1. Okay, so whatever portfolio you choose, you're not going to be able to increase the value of your assets in terms of like the value today by choosing a different portfolio. So that means that choosing the optimal portfolio simplifies to your initial assets, which is invariant to whatever portfolio you choose. And then minus this like regulatory cost of holding a riskier portfolio. And so that means that the optimal thing for you to do is to simply hold a portfolio of risk-less assets. Let's say holding a portfolio of treasuries. And so that means that that's sort of the most basic model that we've been talking about so far that's been successful to explain sort of like decisions on the liability side, to explain reinsurance decisions, kind of like leaves this portfolio puzzle. And so that's something that we would like to sort of like explore now. Now, the literature sort of like has thought about this, and they introduced like various solutions. So one is that you kind of allow for, let's call them like good alpha opportunities, or in some cases even arbitrage opportunities on like corporate bonds and mortgage-backed securities. Okay, so you have some special power as an insurance company while you earn higher returns on a certain portfolio of bonds than other investors that don't have that skill. The second alternative is to assume that investors don't, or that insurance companies don't maximize the like risk-adjusted future value of assets, but instead they just look at the expected value of assets subject to the risk-based capital constraints. And so that's a path that some papers have chosen as well. The third alternative, and that's the one that we're going to explore, is that insurance companies have access to cheap leverage and other investors are leverage constrained. And we're going to see that like third alternative does not require sort of any special power on part of the insurance companies. We can still work with the objective function that we use sort of in lots of other settings, and still get that it's optimal for the insurance company to hold a portfolio of corporate bonds. Now, how does that work? The main sort of assumption is going to be is that households and other institutional investors are leverage constrained. Okay, so that's an assumption shared with like the earlier papers I mentioned. And so essentially all we're going to do is to say, let's sort of like introduce an insurance company in that class of models and see what is the optimal portfolio that they would hold that maximizes firm value. Okay. And so households in this model, they have no bequest motive, they face longevity risk, and they're going to purchase annuities. And so that means that insurance companies are going to have access to a relatively cheap source of leverage. They're going to choose a portfolio of risky assets and a riskless assets subject to this risk-based capital constraint. What we're going to get out of this, and this is sort of the high-level summary, is that it is optimal for the insurance company to hold a leveraged portfolio of low beta assets. The leverage being provided by the insurance that they're underwriting. The low beta assets is coming from the fact that they face this like risk-based capital constraint, and that's like where like providing leverage or where relaxing leverage constraints is the most valuable. So another way to think about that is that essentially in those earlier models with leverage constraints, suppose someone shows up and says like, well, we're going to provide you like a levered portfolio of those low beta assets, then you would be able to charge a fee for that particular fund. And essentially, sort of that's the value that insurance companies are creating. And that's how they're maximizing firm value by deviating from holding only sort of like safe treasuries. Okay. And so what is the countervailing force is this risk-based capital constraint. Okay. So how binding leverage constraints are versus like how important it is to relax leverage constraints versus sort of like how binding, so regulatory constraints versus how binding leverage constraints are ultimately is going to dictate the optimal portfolio that insurance companies choose.
Ralph, can I ask in the spirit of what you're saying, whether liquidity might also play a role? And it seems like they have access to cheap leverage that's also kind of locked in for a long period of time. And so maybe that's another reason to tilt toward corporate bonds, which are relatively liquid versus just like low beta stocks, right? Like it seems like this, the channel you're proposing now would also maybe make them buy low beta stocks. I guess the RBC might be really binding for that. But they might be able to tap leverage that's also unlikely to be pulled on them, in which case they could invest in relatively illiquid stuff, which we think of corporate bonds as being somewhat illiquid.
So that's right. So that is sort of like the mechanism sort of explored in the paper by Knox and Sorensen. And so in that case, you would see that insurance companies would earn sort of like much higher returns on those bonds because of like the liquidity premium that they would be earning. So that would be like a very testable prediction. Now the paper by Chodov Reich and co-authors, what they are arguing is that sort of that they are providing sort of this insurance that they don't have to sell during like I know lots of periods, but during times of stress, they can't really act as what they call asset insulators, and they would also have to rebalance their portfolios. And so that sort of like could be part of the story as well. But it would have a very direct sort of like testable implication in terms of like the liquidity alphas that they would earn.
I mean, in some sense, what you're describing here is very much sounds like Berkshire, right? And Buffett, which is this idea that you have an insurance company and then you're using the float to invest in other things. And so it's both about being levered, but also being able to hold it for a long period of time. That's all I was thinking. But
that's exactly that's very complementary, and that's totally fine. But we will sort of like see that sort of like we will see in this model is that if leverage constraints in the economy do not bind, then you really need something sort of above and beyond sort of like your standard like stochastic discount factor. You need to generate like alphas for you to tilt away from holding treasuries to holding bonds, because you are incurring these like regulatory costs over here. And so you get to the regulatory cost. On top of that, you get duration mismatch. And so it must mean there's a pretty sort of like attractive sort of like benefit from you to move to corporate bonds. So that's sort of the main idea. And sort of like part of that could be like liquidity advantages that insurance companies can benefit from. Part of it is relaxing these leverage constraints, we think. Okay, so in the interest of time, let me just sort of like give you like the main pieces of the model, and then the main results. The slides will contain more details, but I think once I give you the main ingredients, you will be able to follow the main results. Okay, so the financial assets are the following. So there's a riskless asset with an exogenous fixed risk-free rate RF, gross risk rate RF. Insurance companies, they sell annuities. There's an optimization problem in the background and how they set the pricing. And so the return on those, it depends on the risk-free rate. It depends on the survival probability over here that is pi. And then there is sort of like the market power that insurance companies have, which depends on this demand elasticity, like epsilon. And so, so in principle, if markets are like very, very competitive, so epsilon is very large, then for households, the annuities are going to dominate because there's a probability with which they die, they survive probability pi. So they die with probability 1 minus pi. And so in that case, they would get a higher return than simply holding it in cash. Okay, and so that's a dominated asset. Cash is going to be a dominated asset to annuities for those households, unless market power is too extreme. Okay, so we're going to assume that that's not the case. Okay, so then there's like risky assets. So insurance companies are going to pay out dividends. So one important feature of this model is that we're going to solve for the equity prices of insurance companies as an endogenous outcome to the model. Okay, so insurance companies are going to pay out dividends, DI, which is determined by their portfolio choice in the first period 0. Other firms in the economy, non-insurance companies, they have exogenous dividends that follow some factor model. Okay, and this is where the beta structure comes in. So they're going to have some expected dividend. Then there's like some common factor. Different like firms have a different exposure to that common factor. And then there's idiosyncratic shocks, these new I over here. Okay, and so the asset prices for which we want to solve in this model are the non-insurance companies, and then also for the insurance companies. Okay, now what about the insurance companies? They start with initial equity E, and they're going to sell Q units of annuities to the households at a price P of L. Okay, the insurance companies are going to allocate to the other companies, the non-insurers. We're going to assume that one insurer is not going to invest in other insurers, and so it's only sort of like investments outside of the insurance sector. Importantly, they're going to operate subject to this risk-based capital constraint. Okay, and so if they choose a riskier portfolio, that means a higher beta, then C of xi, the regulatory cost, is going to be higher. Okay, and so if the risk-based capital regime is tighter or insurance companies are more constrained, then we think of that as phi over here being higher. Okay, and so the assets in the first period are going to be their equity minus the regulatory cost that they're going to pay for the portfolio that they choose, plus the new policies that they underwrite. What are the dividends that they get in the next period? So first of all, they're going to invest some of their portfolio in other companies. This is the payoff that they get. This is the part of their assets that they put in the risk-free asset, and then they have to pay out some insurance policies. After you like rewrite this a little bit, what you end up with is that you get the payoff from the investment in the other companies. This is what you get out of the investment in risk-free assets. And this is the profits essentially coming from underwriting those insurance policies. And so if the insurance company would choose to invest only in risk-free assets, so there's no investment in corporate bonds, then xi is 0. So the first term vanishes, C of xi is 0 as well. This term vanishes. And what you end up with is that you get the return on your own capital that you invested, plus the underwriting profits. Okay. And so now we're going to see whether there's an incentive for the insurance company to deviate from that, and so that we get riskier dividends instead of like investing everything in safe assets. Okay. Now for the households and institutional investors, it's going to be a very simple problem and very much similar to the leverage constraint models of Black and Virginia Patterson. So there's mean variance preferences for the households. They have risk aversion gamma H, but they're operating subject to a leverage constraint, and so that means in this model that they can't short annuities, which seems reasonable. Then there's like institutional investors, all kinds of other investors in like corporate bonds and treasuries and so on. They also have mean variance preferences. They're also subject to leverage constraints, and those could be heterogeneous across investors. So omega J over here is capturing the strength of that leverage constraint. Now, the way the model is then being solved is that you figure out what is the optimal portfolio choice for households and the other institutional investors, taking prices as given. Then you impose market clearing to solve for the asset prices of the other companies and of the insurance companies. So that's kind of an important feature of this model, is that we don't just solve for like other assets in the economy, but we solve for the asset prices of the constrained institutions, potentially constrained institutions themselves. And then with those prices in hand, we're going to solve those as a function of the insurance company's portfolio. And then in the third step, we're going to say, okay, what is then the optimal portfolio that the insurance company should choose to maximize its firm value? Okay, and then the whole model is solved. So as I said, I'm going to skip some of the details here, but I'm going to sort of highlight the key results that you need to sort of see the main intuition. Optimal portfolio for households and for institutional investors is the standard mean variance demand, inverse of risk aversion, inverse covariance matrix, vector of like risk premia. But now you get this adjustment over here for the leverage constraint for households and for institutional investors. So these Lagrange multipliers over here, lambda, are associated with those leverage constraints. You impose market clearing, so the total demand from insurance companies, from households, and from all the institutions has to equal 1, just a normalization. And then outcome the asset prices. And so what you get over here is the prices of the insurance companies and the non-insurance companies. They depend on whatever the insurance companies do. Okay, and so that's going to be essentially the discounted value over here of expected dividends, the riskiness, and this is essentially the risk premium on those assets. This gamma is the weighted average of the risk aversion coefficients of the other investors. Lambda over here, and that's going to be very important, is the average of the risk of the leverage constraints that are binding for households and for the institutions. Okay, and so you see that sort of like the portfolio of the insurance companies is going to show up by both affecting the leverage constraints, how much they're binding in the economy, and they show up over here, meaning like how much risk do they take kind of like out of the economy and putting it on their balance sheets. Okay, so solving this out a little bit more, you get expressions that look more transparent. So the asset prices of the other firms are the expected dividends. Here you get a risk premium adjustment, okay, depending on the risk aversion and the riskiness of those dividends. And then you have lambda over here, okay, which again is sort of like how binding like the leverage constraints are in the aggregate economy. And so that means that like the only way how insurance companies are going to affect prices is through this lambda. This is the equity price of the insurance company, and that's the one that we're going to work out in more detail now. So essentially what we're going to do is we're going to break it out into 3 pieces. And so the valuation of insurance companies today depends on underwriting profits that we had also, even if they choose like a risk-free portfolio. Then you get a second term over here that depends on like the regulatory frictions. Okay, if they choose a riskier portfolio, you have to pay a higher regulatory cost, and it's going to lower the valuation of insurance companies. And then you have this extra term over here, and that's where they can create value. And the way insurance companies can create value is because they essentially have a lower cost of leverage than other investors in the economy. Okay, so what does that model imply? You can then sort of like choose the optimal portfolio of the insurance companies to maximize firm value. Now, this is the expression that's maybe a little sort of like ugly looking, but I'm going to give you sort of like more intuition sort of in 2 results. First of all, if the leverage constraint is not binding, so if lambda is 0, and if households don't pay a convenience yield, so if there's no like funding advantage to the insurance company, then the optimal thing to do for the insurance company in this model is to choose a portfolio of like just treasuries. Okay, and so that sort of like recovers the portfolio puzzle that we started with, and it's optimal to not invest in corporate bonds at all. Okay, but if these sort of like conditions are violated, and you can think in a broader sense as a convenience yield, potentially the liquidity advantage as well that Alexi mentioned, then you get sort of like different predictions. So first of all, they start to tilt their portfolio towards low beta assets. So if you take the derivative of the optimal allocation to beta, then that one is negative. And so essentially it's optimal for the insurance company to move away from holding only treasuries, but then what they should hold are these low beta assets, because that's going to relax the leverage constraints of other investors. Intuitively, buying the equity of the insurance company is buying a levered portfolio on low beta assets. Now, then the second implication of that is that if you take the cross-partial derivative with respect to beta and phi, and remember that phi was kind of measuring how tight the regulatory constraint was, then that sort of like cross-partial is negative as well. And so that means that if phi is higher, insurance companies are more constrained. They're more inclined to tilt towards like firms that have lower betas. Okay, so they tend to hold a safer portfolio of assets. And so to give you sort of like some evidence for this third implication, which is kind of like the new one over here, we can look at what happens when bonds get downgraded. So of course, when a bond gets downgraded, like bond prices like fall because the riskiness of the bond increases. And so we can't really sort of like judge from that whether that's because like insurance companies are selling and whether this has anything to do with like risk-based capital constraints. But there's a nice paper by Andrew Lul and co-authors that look at bonds that are held by insurers with like high and low risk-based capital ratios. And what they find is that insurance companies that are more constrained, that have low risk-based capital ratios, they're more inclined to sort of like sell these downgraded bonds. And then if you look at the price pattern of those bonds, then you see that those bonds sort of display more what we think of as like fire sales dynamics, where prices fall and then they subsequently recover, compared to those downgraded bonds that are held by insurance companies that are not constrained. Okay, and that sort of like shows this interaction between sort of like risk-based capital constraints and our demand for assets. There's several other papers that look at these, the impact of risk-based capital constraints and the demand for assets by insurance companies. So Bo Becker et al. Look at like mortgage-backed securities. Sean Jay and Mike Weisbach look at P&C companies and show that like in response to weather shocks, insurance companies tend to shift their portfolios towards safer bonds. And another more recent paper by Andrew Lul and co-authors find that VA insurers, they actually reduce their equity risk following the financial crisis, when we think that sort of RBC constraints tightened for the reasons that we've talked about. So there's some extensions that you can have a look at. So the main sort of like takeaway is that sort of like the same model that sort of like explains insurance pricing, like the design of like insurance contracts, like what Moto talked about, and reinsurance, like shadow insurance, should also explain portfolio choice. And we think that this can be done in, for instance, these models where you have leverage constraints. Now, of course, it raises the broader question of like, what is the quantitative impact of like these capital requirements on asset pricing, and the fact that we see this like changing the composition of institutional investors in fixed income markets. And in fact, the main reason that Moto and I sort of started working on our demand system asset pricing paper was, I don't know, exactly to answer that question. I guess 5 years later, we still haven't answered that exact question, but at least we try to develop the tools that can be used to sort of develop to answer these kinds of questions. And so those models are really designed to tackle sort of like give you quantitative answers to these kind of questions. So let me stop here to leave enough time for Moto for the final part for today.
I was just going to say very short, Ralph. It seems like the property casualty ones were very important for the municipal bond market.
Right.
It's gigantic there from your other side. So I'm wondering, is there any research on that, or would that be a good topic as well?
No, it would be a fantastic topic to work on. We think into like understanding why they hold sort of like so much like municipal bonds, and kind of perhaps there's like political economy implications of that, or things like that. But it's a great question. But they play a very important role, and in general, I think municipal bond markets, even though there's kind of an interesting sort of like growing literature on it, I think it's kind of like understudied. And sort of understanding the role that P&C companies play in that market is like really, really interesting.
Yeah,
great observation. Yeah.
Okay. There are no other questions? Moto, jump in.
Great. Okay. So in the remaining few minutes, we wanted to talk about potential research topics on insurance. And the point is to give you an idea that insurance is only like an emerging field that's only started. And there's lots of low-hanging fruit in terms of making big progress on our understanding of how insurance markets work. So we organized kind of these topics around some themes. And then the first theme is kind of new risks that are emerging that could be potentially interesting to explore. So climate risk has been a topic of like intense study recently, but insurance markets provide a unique lens through which we can understand climate risk. Okay, so kind of like the studies that we've seen on climate risk so far are ones where we try to determine whether climate risk is priced in certain types of assets like stocks, bonds, and options. But if you think about kind of pure bets on climate risk, insurance, reinsurance, and catastrophe bonds provide potentially like payoffs that are like most closely tied to climate risk, and therefore we can like infer the presence of climate risk in its pricing through these types of contracts. Yeah, especially reinsurance. Like if you think about, it's a huge market where there's like lots of reinsurance, and the shadow insurance paper that Ralph and I wrote was primarily about life and annuities, and we didn't look at like the PNC type reinsurance contracts. So that data has been very little explored. So I think that's like a very nice area to look at. Okay. I wanted to mention there's increasing interest in climate stress testing, right? So central banks want to know like whether in the future, if like climate risks are realized, which parts of the financial sector are most vulnerable. And together with Rob Richmond, Ralph and I wrote a paper where we kind of set up an asset demand system in order to answer the question of like if there are like shocks to climate shocks, how could that affect the wealth distribution across different types of financial institutions, including insurance companies. So if you're interested in like working on climate risk, climate stress testing, that paper gives you like a start. And we certainly didn't finish that topic, so there's a lot to do there. Cyber risk is another one of those insurance markets where there's very little cyber insurance that's underwritten so far, and the reason is unclear. The one potential reason is that insurance companies don't have enough data, so they can't assess these risks. Another is maybe they know the risks pretty well, or they can calculate the risks, but they don't like the risk distribution where they're exposed to like huge tail risks, like somewhat not very different from maybe like how flood insurance works. So is it the simple fact that these risks are too big to insure, even though the loss distribution is known, or maybe the loss distribution itself is not known? And kind of teasing out these various hypotheses from the data by collecting data on cyber risk in insurance would be very interesting to explore. Along the similar theme, artificial intelligence has kind of made breakthroughs in various fields, and insurance is no exception. So some of you may have like read newspaper articles about insurance companies tracking automobile drivers in order to assess their risks more accurately. Like Tesla's been doing that, for instance, underwriting their own insurance policies, leveraging off of their onboard driving analytics. So this is an area where AI could potentially improve underwriting, a more accurate assessment of risks. And in this type of world, there's a possibility that insurance companies know more about us or more about our risks, our potential risks than do the policyholders, right? They have so much more data than we do. So this could lead to, like, instead of adverse selection where consumers have the information advantage, insurers could have an information advantage that consumers don't, which leads to a theoretical possibility called inverse selection that's been explored by these sets of papers by Abrardi and co-authors and Brunemeyer and co-authors. So kind of coming up with rigorous tests of inverse selection in the data is only emerging, and we haven't seen like lots of papers in that vein, but that would be very interesting to explore. Along the same themes, InsurTech could really break up the traditional insurance business. So for example, could AI simplify underwriting by getting rid of traditional brokers and streamlining the underwriting process? So like companies like Lemonade are making progress, like skipping the traditional brokers and underwriting policies in a particularly maybe attractive way to consumers who want to just go on the internet and shop like insurance as you would for like products on Amazon. Blockchain technology could help automate payments and claims in ways that are much more efficient than traditional methods. And these innovations are especially maybe valuable in emerging markets like China, where there's lots of potential data there to be analyzed. Okay. Now switching over to the topic of the supply side of insurance markets along the lines of the variable annuity chapter that I covered today. We don't have a good idea of like how risk-based capital constraints work across lines of business or in a global insurer across countries and so on. So the papers that Ralph and I have written so far on like our AER paper 2015 and our 2022 paper on market risk insurance. Risk-based capital is at the core of those papers, but we focus on like how risk-based capital affects underwriting and pricing and so on, one market at a time. So like life insurance, annuities, variable annuities, but they could, these constraints could like spill across subsidiaries that are underwriting different lines of business or across, even within groups, across countries and so on. So a good example of that is Shanji's 2022 JF paper, where she shows like there's shocks that spill over from property casualty to life insurance side, but kind of like doing this more systematically and understanding exactly how these constraints work could be like a very good topic of future research. Taxation is like a big part of why the insurance sector exists. So like life insurance policies are not subject to estate taxes or variable annuity returns are not subject to like traditional or it can accumulate tax-free for many years. So these are like potentially tax advantage products, right? So how does like the tax treatment affect how these products are designed in the first place, and how big are these lines of business, and ultimately the size of like financial institutions that sell these types of policies? How are the tax benefits distributed between insurers and policyholders? That's potentially like an interesting topic to explore empirically. And on the shadow insurance topic, Ralph and I have this shadow insurance paper in 2016 where we focused on the capital reasons for doing shadow insurance. That is, by moving liabilities off balance sheet, they can potentially save on capital constraints. And we mentioned taxes in that paper, but we didn't fully explore it. But can taxes potentially explain like the allocation of reinsurance across across domiciles, both onshore and offshore. Okay, that would be like a very good topic of research. I mentioned briefly like the role of insurance brokers in the variable annuity context, but there's a lot to do here. So there's this paper by Egan, Mampos, and Cero, which documents financial misconduct. And interestingly, they find that reports of misconduct are very high among insurance products and annuities, higher than mutual funds, stocks, and other types of financial products. Okay, so how are incentives of brokers important in determining insurance market equilibrium, right? So how big are insurance markets, what types of policies are sold, whether these brokers shift demand across various lines of businesses motivated by commissions and so on. So there's potentially good data there to explore and good questions that can be answered. On the issue of like demand, we introduced you to the random coefficients logit model way of thinking about insurance demand. But more traditional theories of insurance, like the ones based on Yari, look at life cycle demand for insurance. Ralph and I have a paper with Stan van Nieuwburg where we look at insurance choices of US households. And we find that insurance demand doesn't correlate perfectly with the obvious demographics, like whether you have a spouse, children, your wealth, income, mortality expectations, and so on. So what could be like driving this variation in demand across households that's left unexplained? In that paper, we said what could be like preferences for bequests, but kind of nailing this down would be like very good to like using both micro data and perhaps data at the insurance company level. There's lots of questions that can be answered. Okay. On the topic of portfolio choice and asset pricing, topic that Ralph covered today, there's more to do there. So some of you are familiar with the demand system asset pricing literature, where by looking at the portfolios of institutional investors, we can make gains on understanding better where asset prices come from. And because insurance companies are the largest players in the corporate bond market, then this is a natural financial market where by looking at the portfolio choices of insurance companies, which are available through the regulatory Schedule D filings, we can make progress on understanding like where credit risk, how credit risk is priced. As Alexi mentioned earlier, PNC companies are largest in property. PNC companies are largest in muni bond markets. So the demand system asset pricing could also be relevant in the muni bond market in the context of PNC, mutual funds, and other types of institutional investment. Following up on the variable annuities, long-term volatility risk is something that could be of interest to explore. And these variable annuities are maybe closest to what you can get in terms of like data on insurance of long-term volatility. So can you combine like exchange traded options that cover the like more on the short end with variable annuity data that cover more on the long end, and maybe estimate like a volatility risk premium across various maturities? One of the things that has emerged from work that Ralph's done with Binsbergen and others is that short-term volatility appears to have like a higher price of risk, which kind of is puzzling from traditional asset pricing models. And do these puzzles about like or do these puzzles like carry over? How do they relate to like the long run volatility that we can measure from variable annuities that's like completely unexplored? So that would be interesting to look at. Okay, political economy, Ralph mentioned already briefly. Competition between states and countries could lead to regulatory capture and inconsistent regulation, differences in accounting standards, tax treatments. So key questions are like, how does this determine like the location of insurance companies and where the liabilities are located across within countries and across countries? Does it affect pricing and the size of the insurance sector and so on? This will be very interesting to explore. And there's very little work on optimal regulation, right? So a lot of the work that Ralph and I have done are like the consequences of regulation on like observables, like how contracts are priced and so on, and the size of the insurance sector and reinsurance. But these regulations are not necessarily like permanent. They're certainly changing over time. Good example being like Solvency II in Europe. So if you're kind of good at theory, this is a good chance for you to like think about insurance in optimal contracting sense and how to design optimal regulation. One issue that emerges in insurance is that the types of risks that insurance companies face are somewhat different than banks that have runnable deposits. So the liabilities are less runnable, but then the key risk is more like long-term liabilities that are hard to hedge with available assets. So temporarily, you might want insurance companies to run a deficit. In the long run, they might recover. So the idea of value at risk, it should be like a more of a long run constraint rather than a short one. So this is the issues to explore and to kind of formalize. Okay, so I think I'm out of time, so I want to end here. And thank you so much for your attention. And I hope this session was like motivating in terms of like, well, insurance is like a very interesting area to explore, and if anything, underexplored in terms of research, but there's abundant data. And if you want to get started, Ralph and I recently published a textbook on the financial economics of insurance, and more information is, so we have extensive lecture notes also at insurance.princeton.edu, where we posted the complete set of notes on insurance. Today we were only able to cover essentially like three of the chapters, but this website has all the chapters, all the notes, if you're teaching insurance or more interested in learning more about it. Okay, so thank you so much, and thank you so much, Alexi, for inviting us to be part of the summer school.
Thank you, Moto and Ralph. This was really great, and like having all these ideas at the end, I think will be very useful for students who are interested in the area. So we really appreciate it, and we look forward to all the follow-up work that will come out of it. Thank you all. This will be the end for today. We'll be back tomorrow again at 9 a.m. Eastern. The topic, instead of insurance companies, will be banks. So sticking with the financial institutions theme. And it will be me and Olivier Wang, and we'll be talking about banks and interest rates. See you all tomorrow.